to see you guys today. Hope everyone's doing great. Hey, Better Dad. I hope you guys didn't have a mental breakdown because the servers were down for a little bit, guys. It's funny watching everybody start clamoring. Happens sometimes. Technical difficulties, they're a part of life. Don't let it stress you. Don't let it stress you. 252 trading days a year, guys. If you miss out an hour pre-market, you're probably going to be all right. Probably going to be all right. You'll start me out with a good one, Tucky. I'm afraid to ask, but we're going to skip straight to Tucky's and see what's going on. At what point do I quit looking at the 13.2 and start relying on the 5.1? So the 13.2 shows a wide gap between the small triggers and the large triggers. It shows we are above the mid band. The only thing holding us back from going to the upside is purple 1-to-1s. So Tucky, do you see that big red fat Fibonacci area? I want to make sure that you see it. So when do we stop and start watching? So here's the deal, Tucky. Good, great. This is great. This is great. This is great. I love it. So I'm going to use this for a segue, and we're going to come back and we're going to do this picture. And the part that you've got to get, and it's going to help you. It's going to help you a lot. And you almost covered it up here. But this fib is problematic. Do you see how those trigger lines, the small triggers, one of them is trying, the bottom is trying to break above it. The top one made it, but the bottom one didn't. This fib is still very much in play. It really is. It's very much in play right now. And the fact that your smaller, faster chart has multiple divergences right from that key area. So we're going to talk about this. So when I go through the very basic rules, Tucky, we're gonna answer your question on when it's time to go back and to go look at that 5-1 chart. And I'm going to tell you, and Tucky, let me preface this. When we talk about the trades in the morning here, when we do this first hour, I want you to remember that I'm giving you the best of the best, Tucky. I'm giving you the highest probability. I'm giving you the most amazing, just sexy as it can be kind of scenarios. And what that means is that there will be times where you have these really wide triggers, like you see them here, and you love that. You clearly focus on momentum. That's only 1/3 of the equation. And you've got to throw termination conditions in there too. And what that means to you is that there's going to be times where you can trade to them and then you have to pause. And there's times where you don't have the momentum that you need and you pause. And as we go through this morning, guys, we're going to talk about what's called a high probability trend trade. So right here in the moment, we're going to talk about this trigger look and we're going to define that as a strong trigger. We're also going to talk about this blue line that could be problematic. It has the potential to break because of the trigger location. But Tucky, this would be the time when you look at your large chart and you say, I have all the momentum I could ever hope for, and I'm coming from a strong top, and this area has the potential to break. Let me go to my small chart and see if I can find an entry. Let me go to my small chart and refine and pinpoint where the market is most likely to bounce, where it's most likely to continue. So the Sunday school answer is you go to the small chart when the rules are met on the large chart, because your large chart is going to give you the advantages that you need. So I'm giving away everything here. But it's good, Tucky, because that's such a great question. And that small chart is like a siren song, man. And if you don't have those advantages coming from the large chart, she's going to talk you into trouble. She's going to pull you onto the rocks and crush your your boat, and you're going to sink and drown, and life's going to be sad. It's going to ruin Christmas, Tucky. We don't want that. So let's check news real quick, guys. Today's Wednesday, May 7th. At 10:30 a.m., we've got crude oil inventories. And then at 2 p.m., guys, FOMC. The craziest market movement you'll ever see. Talk about something that can disrupt patterns. So every morning I'm going to forexfactory.com/calendar, and I'm just checking news. I want to see what's going on. I want to make sure there's nothing that could disrupt my patterns. The patterns that we're teaching come from the Nexgen page, guys. More specifically, they're coming from the trading guide right here. And all the answers that you need, Ron, not at the beach, FOMC, he will be, Jen. All the answers that you need come from right here, guys. Everything we do every day in the morning is focused on the best of the best, giving you the highest chance of success. And we do that with what we call a high probability trade. A high probability trade is defined as when each indicator on every chart agrees with the rules for the trade. The bikini thing cracks me up every time. Guys, this is when triggers are their strongest, when the path is clear, when there's nothing between you and your targets. And that high probability trend trade is a trade that typically wins 70 to 80% of the time. And there's a lot of confidence that comes in when you're winning that much. But the most important thing that the high probability trend trade does, and then Tucky, this is the first thing that I want you to really pay attention to when I say it, is it teaches you to read your indicators, guys. It teaches you to recognize the advantages that you need to feel good about entering. Yeah, Pete. It teaches you to feel good about the trade that you're entering because you know you have an advantage. You know you have an edge. You know you're going into it with a higher chance of winning than losing. And then, Tucky, this is the one part that I want you to listen to, and this is important. Your chart reading, you're waiting for those advantages. It encompasses about 90% of your day. There is a tremendous amount of waiting in successful day trading. There's a lot of doing nothing in successful day trading. 90% of your day will actually be spent waiting for these advantages. 10% of your day will be spent doing nothing. And I think the consensus in the room would be, if you asked everybody, the days where you're doing less are typically the days that you're doing more, because you're going to find yourself trading with advantages. You're going to have an edge when you enter that market. So I encourage you guys, embrace the idea that you'll be doing a lot of nothing. But you'll be doing a lot of nothing because when you get to that 10%, when it's time to take a trade, you're going to know that you have a pattern that's been proven to win more than it loses. So focus on that chart read, guys. No, because Steve, I had a power outage here. I had a power outage. It killed the internet. It killed everything on my end for about 4 hours. And it happened when John Novak was being smart, unfortunately. So most of what he talked about yesterday, we'll talk about again today. Don't worry. Most of it was just basic Trading View 101 is all it was. There wasn't anything groundbreaking that came out of yesterday. Just some good information. Guys, we're going to talk about this highest probability trend trade because it's simple, because it's small, it's few moving parts. It's only 3 rules, and each rule creates an advantage. So strong trigger lines gives the advantage of momentum. And no termination conditions, guys, room to the profit targets, that's going to give you a clear path. Momentum and path. These are the two. Once you understand momentum and path, once you understand the areas that can stop the market, once you know how to define momentum, you have everything you need to create a plan. You have everything you need to find success, to be consistent, to be profitable. Initially, we're teaching the entry for the highest probability trend trade as well. And this entry is just designed to show you where the trend is most likely to continue. And this entry is only entertained when the first 2 rules are met, when you have momentum and path. And Tucky, I think that's your sticking point. Is you're so excited to take a trade. I know I was the same way. I was so excited to take a trade that if this chart was almost good, I wanted to go and I wanted to find it. And I was watching the market go up, even though I wasn't supposed to go there yet. I was watching the market make these moves, even though my rules weren't met. And the reason we focus on the high probability trend trade first is because it allows you to dissect the movement of the market. It allows you to look at a large chart first and to define the direction of the market, to establish momentum through rule number one, and to identify any things that could be problematic through rule number two. And when you have a market, excuse me, that is absolutely railing in the direction of the trend with nothing in the way, that is when you go to a small chart. That's when you entertain the idea of an entry. And the entry shows all these inner workings inside of one bar on the large chart. It shows a pullback, it shows a bounce, it shows continuation. Rule number three is designed to have you pinpointing where that bounce is most likely to happen. And that's rule number three. And we go to the small chart when the large chart says it's okay. Does that make sense, Tucky? And for the brand new user, when the large chart says it's okay is a very specific moment. But as you grow with the software, guys, as you learn to read the software, what you'll find is more opportunity. When you begin speaking to yourselves in terms of advantages, when you look at a chart and you say, I have momentum and my path is clear, I'm going to find an entry, that turns into, I can identify that my momentum isn't great, but I have these other advantages. I'm going to find a way. I'm going to find a way to get paid. I'm going to find a way to get an entry. I'm going to find a way to manage assertively. And that comes from your chart reading. So we focus on this best of the best first to open doors for you through your chart reading. So large chart leads the way. Big, slow chart, broad stroke of a brush. Rules 1 and 2 are going to be met there. Small chart is your pinpointing. That's your accuracy. That's the awesomeness of rule number 3, showing you right where the market is going to bounce and continue more often than not. We use these two charts because I love it when you guys ask yourself, who am I trading with? Who am I trading against, guys? The large chart is the big crowd. These people create trends and then they create that momentum and they react at key areas. And the large crowd typically wins. So the rules are designed to keep you in step with the large crowd. Your small chart is like a small crowd, a group of fighters, of ne'er-do-wellers, if you will. And they create little ripples, little retracements, little fights against everything that the large crowd wants. Your entry rules on the small chart are designed to have you pinpointing right where that small crowd is most likely to fail. And they typically fail 70 to 80% of the time, which means that when the large chart leads the way, when the momentum is there, when the path is clear, and you define your entry using a smaller, faster chart, you're putting yourself in a position to find success potentially up to 70 to 80% of the time. And that's what gets the confidence going, guys, and that's what teaches you to see the other trades. So we'll keep it basic in the morning, and we'll learn the trigger line of Fibonacci rules for when it's okay to trade. I always encourage you guys, it's okay to trade when my rules are met, because my rules describe a pattern, and that pattern can be tested, repeated, and proven to win more than it loses. So it's an edge, it's an advantage. I want all of you simulating, practicing. Don't wait until you think you're perfect to start trying to take trades. Take them, drop them in the room. So Tucky, as you're working through this big chart, little chart, take the trades you think you see. We'll talk about them. Take your entries, take your exits, identify the advantages. Go back and talk about what you saw and what made you want to take that trade. And if you do that every time, I took this trade because it had the potential to break with all that momentum, and I could define an entry and mark, this is what I saw, and this is what I did, and this is where I did it, and that's where I exited. And do me a favor, give me a little feedback. And Tucky, we'll work through it together. Every trade you take, every time you post in my room, it's a private session. You and I are going to have a conversation. We're going to go back to those advantages. It happens. So how many pictures of your trades did you post in the room yesterday? How many pictures of your trades did you take? And you don't even have to answer. Don't let me put you on the spot. But if every trade you take, Tucky, you drop it in the room. And Bob, don't let me down. I'm going to open it up, and you're going to show me what you got. Small and large trigger rolled. Okay. Bob, what are you looking at? Oh, that's your 5-1. And now we're doing this. So Bob, how did you have an HVA opportunity without a large chart termination? And this is one of the, yeah, we all get pissed sometimes. Bob, this is one of those ones. What did the large chart look like? Because there's a whole nother chart with rules. And sometimes that's the feedback you'll get. It's an incomplete picture. Was it really an HVA trade? Did you have a clear path, right? Did you follow the rules? So every time you post in the room, guys, I promise you, I'm going to give you, I love that. Keep practicing, but remember that it starts with a large chart termination, Bob. So as you commit these looks to memory, get that large chart in there. Or if you know that it was a termination, right? Annotate it. Start writing those rules out so it's easier to follow those rules. But every picture in the room is a private session. Every picture in the room is an analysis on how you're reading your software, on your entries, on your exits, opportunities for management, guys. And I gave you all 5.5 years of my chart reading to help you become a more efficient chart reader. The hope, I love it, Bob. The hope is that you keep posting in the room until you're sure you're taking the correct trades. So sometimes we have horrible days and we're like, oh, I'm so angry and I'm chasing stuff and I'm not sure why, and I've done it. And then guys, I come through and I posted a picture in my brother's room. He used to teach this room, and he goes, hey Mark, guess what? And I'm like, what? And I'm already fuming because the market owes me something. And he goes, let's just talk about termination conditions. He goes, Mark, let's talk about when price reaches an area and the triggers don't break it, because this look right here says that could happen. And you keep taking trades into these lines, Mark. And I was like, oh my gosh, I never even noticed it. I was so intently looking at the small chart that I forgot to let the large chart lead the way. And when you get caught up in the moment and focused on the money, sometimes you bypass the process, guys. And that's one of the wonderful things. I don't have any connection to your trades. I don't have any fear of winning, any fear of losing. I'm looking at it as an impartial bystander saying, well, yes, you did have momentum. And without a doubt, you hadn't reached the area. And for sure, you got in at an area right at the triggers and cab. What a great long with this momentum to take you up to trouble. And he did it expertly. And all I can really do is just high five Cav. Hey, Cav, great job, nice trade. Let's repeat this one. Let's do this one every day. Let's keep focusing on that trade that's producing the advantages. And you'll find that there's something in every trade. And sometimes just the celebration of the good stuff, the attaboys. I work off of attaboys, guy. If John Novak says, hey, Mark, good job today, one day he's going to do it, then I want to do a better job tomorrow. And that's just how I work, and I think most humans do. So post in the room, guys. Get that feedback. And then keep it simple initially. This is why we talk about one trade. Focus on getting really good at one thing. And then when you're good at that, when you're consistent at that, that's when you add the next. So I'm going to hand you a plan. It's called the KISS plan. And the KISS plan is only 2 trades deep. And it starts with the high probability trend trade, the best of the best way to enter it in a very, very mellow way, emotionless way to manage it as you learn to read your indicators. You've got to learn the looks you'll commit to. So you've got to learn those large chart looks. You've got to learn those small chart looks. And that is the second part of becoming a confident trader. This says track your real-time performance, and that's how it started out. But it evolved into a 4-tab spreadsheet, guys, because I think study in pictures is one of the most important things you can do. So your first tab is an entire section dedicated to what it looks like to have rule number 1 met. Strong triggers. And then the next section is what it looks like when that rule is gone. That's your 90%, when it's time to sit on your hands as a brand new user. Exactly what it looks like to have a clear path, nothing in the way, room to your profit targets. And what it looks like, and Tucky, I suspect this is maybe part of your challenge, what it looks like when that path isn't clear, when the market could produce a bounce, when that trend could end and where it could end. So knowing the difference between the two as you look for your rules to be met, and then a little bit on entries. Second tab is client trades. This is where I thank you guys for all your amazing pictures. When you show the perfect high probability trend trade long, a great 50-50, an awesome use of management, guys, I steal it. And I put it in the green section, and we're just creating a study guide for all you new users to look at. So if you're struggling with the pattern, go back and look at it 100 times. It'll start to cement itself in your brain. There's the entry sequences, both long and short, getting you in the best of the best spot with the least amount of risk. Ideas on management. There's even a place for you to build your plan. So this would be every time the rules are met, every time the advantage is there. Win or lose, if it's the pattern, get it in here. Commit it to memory. We're going to start working on management. I'm going to give you the basic management, but you're going to see more. You'll do more. And then you're going to start to see things that are repeating themselves. And then finally, this is the one that paid the most dividends for me. This is the trade tracking sheet. And this is how I began to recognize the challenges that I was having, because I didn't see them in the moment. I was so focused on the entry that I missed the terminations, guys. So every time I would take a trade, I would start putting this picture in here. And it would be annotated, and it would talk about what I saw. And then I would put the feedback that I got from John Novak off to the side. So what I saw and what was true wasn't always the same thing. And I began to see these things, and this was mine. Into a termination, into a termination, into a termination. And I knew that my thing was breaking rule number 2. I knew that I was taking away that advantage of a clear path, and I was losing more than I was winning every time I did it. And in a very loving voice, my brother said, how many times are you going to break this rule until you get sick of losing money? And it turned out it was a pretty big number, but I didn't even recognize it. I needed that feedback in the room. I needed to go back and study this and know that that's what I was doing, and that's where my challenge was. So if every morning you wake up and look at what you did yesterday, ask yourself what worked, ask yourself what didn't work, set yourself up for the day, focusing on the good and avoiding the bad. You'll begin to see patterns in the market that are bringing you all the successes you could ever hope for, but you're also going to see patterns in the market that are taking those successes. And even more importantly, you're going to see the patterns in you, trading in determination conditions, jumping in early, the things that you need to adjust. And guys, I'll give you the feedback and a plan, and we'll work through it together and get you over that hurdle. So we're going to take the next 30 minutes or so to learn the trigger line and Fibonacci rules for when it's okay to trade. 30 minutes is all it takes, guys. It's just a look on a chart, and we're going to learn how to see it. We're going to associate an advantage to it, and we're going to piece those 3 advantages together to create a trade. Don't hesitate to post in the room, guys. If you are looking at your chart, and I can't stress this enough, if you open up a chart and you're like, hey, Mark, what is that? Drop it in the room. What is that yellow dot? And just drop it in there. No worries. We'll answer it. We'll take care of it. And then Lonnie just did that. Is this a termination? Is this still a termination of the situation? They didn't print all the way across. So Lonnie, where price reached it, where the triggers remained above, 100%. You actually have 3 termination conditions in the same spot. And that termination condition is right here. And until that termination condition breaks or everything stops printing, absolutely, this stays active until they stop printing. So your 1-to-1s are no longer a problem, Lonnie, when they stop printing. Your fib is no longer on the radar when it stops printing. Does that make sense? Great question. And guys, that's a great example of how all you have to do is drop a chart in, and you will get your answers. The only questions that will not be answered in this room are the ones that are not asked. So let's learn rules. You guys simulate, post in the room, simplify, keep it simple, keep it focused. And guys, we're going to go learn some stuff. And we're going to start with just identifying, hey, good morning, Better Dad. We are going to start by identifying just what we're looking at. So both charts, large and small, will have trigger lines, guys. And we have small and large triggers. And that's all you need to know about them. These are small, and these are large, and these are small, and these are large. And when they're green, they're going up, and when they're red, they're going down. And guys, you're going to use trigger lines in everything that you do. You're going to use trigger lines to be sure you have the advantage of momentum, rule number 1. You're going to use trigger lines to define termination conditions, making sure you have a clear path, rule number 2. And you're going to use these large triggers, guys, and you're going to be able to pinpoint your entries by looking for areas inside of those triggers. So triggers show up in everything, and the deepest you need to get into it is these are small and these are large. And then both charts have areas. And areas have a different role depending on the chart, but they all have the same name. There's going to be divergence highs. This is a magenta line. It's going to print off of this pivot when your software runs calculations and it realizes that even though price got up to here, the momentum was falling behind. It's a loss of momentum. That's what I want you to associate divergence with. If it happens at a low pivot, you see the cyan line, the baby blue line. You're going to see Fibonacci resistance all day long. You're going to see Fibonacci support. You're going to see yellow 1-to-1s, and you're going to see a mid-band, guys. And these areas on a large chart are where that large crowd are making decisions. This is where the market has the potential to have a high or a low, one of those termination conditions. On the small chart, we're going to use these areas for entry. So we're going to break it down so you guys know which chart to look at, where to find your advantages, and how to piece them together to create the highest probability trend trade that Nexgen teaches. And it all starts on the large chart. The large chart has to lead the way, guys. That big, slow-moving chart, it must have strong triggers because when I have the advantage of momentum, it's a market that's difficult to stop. And the only way to have it is to trade with the trend. The trend is your friend. I just made that up right now. The trend is your friend. I think it's going to be big. Guys, if the background is green, the trend is up. If the background is red, the trend is down. And you're only looking for rules to be met for high probability trend trades in the direction of the trend. And one of the things that's going to keep you focused on that is you can only have strong triggers. You can only have rule number 1 met if the trigger lines in the background colors match. If the smalls and large are the same color as the background, you can have strong triggers. But strong triggers isn't just colors. Strong triggers is when the smalls break above and away from the large triggers. When the large triggers are wide, that space in between the two, guys, I want you to picture scissors that have opened up, that are ready to cut. This separation between small and large, this lets me know that the odds are favorable for the market to continue up. And then in a downtrend, the smalls below, large or wide, the scissors are open, the space is present. This is your strong trigger look. This is when the odds are favorable for the market to continue down. You're going to hear odds favorable momentum all day in this room. You're going to see it annotated on charts, OFM, all day in this room, guys. Momentum drives a market in the direction of the trend. Momentum is what we look for to have the potential to break key areas. Momentum is when you're using that refinement chart to pinpoint where these tails are most likely to form. These tails with all that momentum are potential entries for you. And my favorite thing about momentum, guys, is momentum is so difficult to stop on that large chart that a lot of the times it'll help cover some of the mistakes that we tend to make as new users. So strength leads the way. It's rule number 1 for a reason. And when those scissors close, when the small triggers work their way back inside of the large triggers, that's the weakening of the large triggers. They're no longer strong. And anything can happen up or down. And I like using words to describe looks, guys. This is strong, odds favorable. I can't wait to look for my next rule. This is weak. Anything can happen. I'm content just waiting, just sitting on my hands doing nothing until the market shows me the strength that I need so that I can go look and make sure that I have a clear path. That's rule number one. I mean, I can describe it in one slide. This is probably the easiest rule for most people. It's not difficult to recognize, guys. When the smalls separate from the large, this is the momentum that we're looking for to have rule number one met. When the colors don't match, I don't have odds favorable momentum. If the smalls are red and the large are red, but the background is green, I don't have odds favorable momentum. If the smalls are inside of the large, this weakness is exactly what gave us this big retracement from the middle of nowhere. Strength breaks areas, and guys, I think this is beautiful. That tail with all that momentum is a potential entry. That tail with all that momentum is a potential entry. So you're going to start getting in the habit of saying, man, with that strong trigger look, I'm going to see if I can find some opportunities. I'm going to go back historically. I'm going to look at these, and I'm going to see if there was an opportunity to make a little money in a market that was pushing as hard as it could in the direction of the trend. Can you guys give me a why if you're with me? This is the one. Guys, this is the one that leads the way. It is definitely rule number one for a reason. And then once it's true, thank you for that, Ron. Once it's true, I have to make sure there's not a brick wall in the way. Guys, termination conditions false. That means that I have room to my profit targets. If I have room to my profit targets, I'm going to call it a clear path. So I have a freight train of emotion screaming down the highway, and if my path is clear, there is nothing to upset the apple cart, guys. Termination conditions are Fibonacci-based indicators that may reverse the market. Termination conditions have the potential to be horizontal lines on your large chart, the big chart, the slow chart. It can be a divergence high or a divergence low. It can be Fibonacci resistance, Fibonacci support, yellow one-to-ones. All of these areas are capable. One second, Lonnie. All of these areas are capable of stopping the market, of creating reversals, of being highs and lows. These are the areas where the large crowd are making decisions, guys, where the fights happen, where the bounces come from. So in order to identify a termination condition, you allow the large chart to get there. So Lonnie, I'm going to answer your question real quick. Rule number one for identifying a termination condition is allowing price to reach an area. Letting the price bars get up to Fibonacci resistance, divergence high, yellow one-to-ones, letting it get down to Fibonacci support, divergence low, yellow one-to-ones. So guys, divergence is born when there is a loss of momentum at a pivot. So the market goes up and the market goes down, and Lonnie, right about here, the calculation is done to define that divergence. That's when the first divergence is printed. So in this case, price didn't reach that divergence. Price actually creates that divergence. Does that make sense? And that's important because price has to reach an area in order for it to be a termination. So if it reaches the area, all you have to do is ask yourself, where are my triggers? And Lonnie, I'm going to go back and show you a couple great examples of how we use these divergence highs. It's the same way. Price reaches the area, where are my triggers? Well, my triggers, small and large, remain below resistance. They remain below yellow one-to-ones. They remain below a divergence high. That defines that line, that area, as a termination condition, guys. And there's a couple things that can happen here. That area could break. Areas break all the time, usually with momentum, sometimes without. That area could create a 3 or 4 bar bounce, and that 3 or 4 bar bounce will be enough to pull you out of a long position if you trade directly into it. The area, buyers and sellers could just fight for a minute, creating that bounce both directions, making it impossible to find your pattern. Or that termination condition could reverse the market, guys. And if it reverses the market, it's what we call a strong top. And a strong top is the precursor to the highest probability trend trade that you can ever take. A strong top is rule number one for that HVA trade, for the momentum trade. A strong top is rule number one for those trades with the potential to break the next area. So strong top or bottom doesn't work its way into the rules for a high probability trend trade. But rather, if you have it, it sets you up for the highest probability trend trade you could ever take in the other direction. If price comes down and reaches Fibonacci support, same thing. Where are my triggers? And if they remain above Fibonacci support is a termination condition. All of those things could happen. It could break, it could bounce, it could fight, it could reverse, become a strong bottom, and you'll never know what the reaction is going to be. And this is very much a part of your 90%, is waiting for the opportunities, waiting for the area to clear, or waiting for it to reverse and go the other way so that you can find your rules met. So if rule number 2 is not met, the short of it is don't trade into the area. That's how you stay out of losses that you shouldn't be taking. And I'm going to share this with you real quick, guys. When the market goes up and down, those are pivots, right? And very often these can happen at termination conditions. And we're going to Lonnie's question here. If there's a loss of momentum, you see the line. That just tells me there's a loss of momentum at the line. Lonnie, these lines can't become termination conditions until price comes back and reaches them. So this divergence high is created here, but when price reaches that divergence high and the triggers remain below, now it becomes a termination condition, and then if it reverses the market, it becomes a strong top. Here, there's just a loss of momentum, but when price reaches the divergence low, when the triggers remain above, now it's a termination condition, and if it reverses the market, then it's a strong bottom. Does that make sense? That's one of the most misunderstood concepts, I think, Lonnie, because we're like, well, I've got divergence, but it has to reach that divergence to be the termination. And guys, that's how you're going to define termination conditions. There's one with a big untradeable bounce. There's one that reversed the market. That one drove the market all the way down to Fibonacci support. These termination conditions defined a range that you didn't want to be caught in. That's consolidation, guys. That's chop. That's you staying out of the market, not giving away money, not taking unnecessary losers, because rule number 2 doesn't give you a clear path. Pretty cool, right? That's this morning in the S&P. What a safeguard. Guys, areas break all the time. And this is what it looks like when they break. So in order for this resistance to be considered broken, both small triggers and large triggers have to get above that area of resistance. Resistance will begin to behave as support. And guys, your path remains clear all the way until price reaches the next area. And once it reaches the next area, this is where you start all over again. Price reached the area. Where are my triggers? They're all below. Guys, this line remains a termination condition until small and large get above it, and then it behaves as support. Go in the other direction. The market's coming down. We're looking at Fibonacci support right here. Once the small triggers and the large triggers, both lines of each, get below support, support's considered broken. It behaves as resistance. Your path is clear, and your path remains clear until you reach the next area. So for the brand new user, let it be black and white. Let it either be a termination condition, absolutely no trades into the area, or let it be a clear path. With momentum, look for your opportunities to trade to the next area. And then once you can do that, once you can recognize the difference between a termination condition and a clear path, it opens you up for the 50-50 look. And I added this slide in today, guys. As long as you have strong triggers, as long as you have odds favorable momentum, if 50% of your triggers break the area, small triggers smash through resistance, large or small triggers smash through resistance and support, 3 to 4 points beyond, but 50% of your triggers remain below support here, or below resistance, sorry, or above support here. 50% of my triggers are through, 50% are not, 50% are through, 50% or not, guys. We call this a 50-50 trade. Pretty clever, right? You could call it a straddle trade. You could call it a one above, one below trade. It doesn't matter. But as long as you have momentum, these areas have the potential to break. But it's only potential, which means that if you find an opportunity, if you take that trade, you just have to manage it a little more assertively. And there are some key looks on a small chart that will let you know when that potential is going away. It's in the plan that I'm going to give you. This is the second trade on the plan that you're going to get. So let's go again, live market. I love using live market examples. Weakness, big retracement, right to resistance, weakness, big retracement. There's your divergence being a termination condition, Lonnie. Here it's a loss of momentum. Here it's a termination. That termination reverses the market, creates odds favorable momentum, and the market goes right to Fibonacci, damn near to the tick, and creates a big untradeable bounce. And then it retests support, divergence low, triggers can't break, and off it goes the other direction. These one-to-ones had the potential to break, but they didn't. You can see through the tails the fights that happen right at this key area. And the sellers say, you know what? We needed to hit this Fibonacci area to the tick, not 2 ticks above it. And once they did, guys, look what the market's doing. Termination, reversal, and we've got momentum to the upside, and this market is flying from what we're going to call a strong bottom. This is the fight between buyers and sellers. This is the buyers taking control and pushing the market up from a strong bottom. We have odds favorable momentum. One-to-ones have the potential to break. Fibonacci resistance hasn't yet been reached. Guys, there may be an opportunity brewing, but you've got to know the basic. You've got to know termination versus clear path. It's going to open the door for a lot of trades for you. And Tucky, that may be where you're headed. But there will be times. Never looked at it which way, Lonnie. There's going to be times, and for me, that's a win. If you hear something differently or see it differently from the repetition, that's exactly why I say the same thing every day. Awesome. Does it help to see it like that? All it is a fight between buyers and sellers, guys. When I have strong triggers down, I know that the sellers are in control. And when I see Fibonacci looming in the distance, I know that that's where the sellers might exit. I know that's where the buyers may try to fight. And it's pretty cool. And you'll see how this happens. So the buyers test the waters, right? And the sellers say no. And the buyers push just a little bit higher. And the sellers say no. And the buyers say, all right, we're going to unload a little bit. And you saw how quickly it went up. And the seller said, that's cool. But we got some areas that may trip you up, buyers. We're going to make you work for it. And you can see how the market is dancing right around the decision-making zone. It's pretty cool. There's going to be times where your path isn't clear because areas are stacked. There's going to be times where you have to be patient. There's going to be times where you're doing nothing, guys. That's 90% of your day. It's okay to do nothing. Futures markets trade billions every day, guys. The S&P trades 174 million on average a day. That's what's exchanged. You need to be able to find $400. $400 with momentum and a clear path puts you in a 6-figure income, guys, if you can do it each and every day. And that's terminations, guys. That is terminations on a large chart. And it's areas. You're going to be able to predict highs and lows. You're going to know where the market can turn. You're going to have a recipe to respect them. There's one termination condition that you're going to see on a small chart, and that's 3 divergences in the same price range. 3 divergences can stop a trend, guys. 3 divergences can create an untradeable bounce. 3 divergences can show you change that you can't yet see on the large chart because this is down with all the momentum and the potential to break. And the small chart is showing you through losses of momentum that they may want to push a little bit higher. On a small chart, that's enough to keep me from taking an entry. Guys, on a large chart, 3 divergences in the same price range, that's where the market is more likely to push up. And that's exactly what's happening right now. Patterns repeat themselves every day. Some of you might have found a way to enter the market right there. We'll go back and look at it when there's entries. But guys, momentum and path. This is it. Momentum and path. This is the good stuff. This is the core. Once you can identify these two, you're going to find trades. You're going to find trades that are high probability trend trades. You're going to find trades that are medium probability trend trades. You're going to see trades that are like Bob's trade, using a high volume area to get in closer to that termination condition. You're going to find ways to use momentum and nothing but momentum, guys. But learn how to look at your charts and say, I have this advantage. I can't wait to look for that advantage. And if these two are present, I'm going to the entry. That's what's going to get you set up. So entries are small chart. Entries are the siren song, guys. Entries are where you're going to pinpoint where the market is most likely to bounce, where it's most likely to continue with the momentum, with the clear path, with the already established trend. And guys, it's so precise and so specific that you're going to use a limit order to buy or sell a pullback at an area inside of triggers. A limit order means you're going to wait for the market to come to you. That pullback is the fight by the small crowd. We're going to use areas, fibs, mid-bands, and yellow 1-to-1s inside of triggers. Areas can create a bounce the same way they did for termination conditions. They can create a bounce in the direction of the trend. And then, guys, they need to be inside of triggers. Triggers are what we use to define where the retracement is most likely to go. Large and synthetic, guys. You've got large triggers. They're smooth. They're native to the 5-1. When you compare them to the small triggers, you can define momentum on a small chart. You also have synthetic triggers, and synthetic triggers are nothing more than the large triggers from the large chart. Price returns to large triggers. It's the coolest phenomenon ever. So I teach you guys, buy or sell a pullback at an area inside of triggers. Inside of favorable large triggers is going to increase accuracy. Favorable large triggers means that the large and synthetic are one on top of each other, riding piggyback. And this gives you the smallest little space where the market is most likely to retrace. It's the smallest amount of space to have a fib, to have a midband, to have a yellow 1-to-1 inside of them. And those are where we expect the market to bounce. That's where we're going to take our entries. So in order to define your entry, first, the large chart rules must be met. You're looking to make sure that you're trading with the trend. You're looking to make sure that you have strong triggers. You're insisting that there are no termination conditions in the way. And guys, when that happens, your small chart looks like this about right here. Everything is up. Everything is strong. It's green bar after green bar after green bar. And this is where you guys go, oh my gosh, it's going without me. I'm never going to get paid. This is no good. What's Novak teaching me? And then your pattern, your entry pattern begins, guys. And it begins with a reversal bar. This reversal bar signals the beginning of the pullback, the retracement, the fight from the small crowd. The reversal bar, the down bar after all of these up bars is not your entry. And guys, if you couldn't hold your water and you just jumped in to ride that momentum, this reversal bar is your signal that that momentum is over. That's a great exit condition. But the reversal bar starts the pullback. You can define where that pullback is most likely to go using large and synthetic triggers. And this red box, and it's a little expanded, shows you where the retracement is most likely to occur, where those down bars are most likely to go down. And then it's the areas inside, and I always go all caps when I annotate this. Your entries will be defined, the point where the market is most likely to bounce will be defined by fibs, midbands, or yellow 1-to-1s inside of triggers. Sometimes there's multiple areas. So from the highest area to the lowest area, that's your box. That's your window of opportunity. This is where the small crowd is most likely to fail. This is where the market is most likely to bounce, continue with that underlying trend. But you're going to activate a limit order 2 ticks above that highest point of support, because the large chart is screaming to the upside. There's absolutely nothing in the way to create a bounce. And let's be honest, we don't expect the small crowd to get much further than that highest point of support. They could go to the 1-to-1s and bounce and continue with the trend. They could also retrace to the bottom of the triggers and maybe decide to go with the trend. or they might break through. They might get through the areas inside of triggers. They might get to the bottom of the triggers and right through it. And guys, once that happens, once that small crowd, once that small chart pushes beyond the areas most likely to create a bounce, beyond the areas most likely to define the retracement, once you get to what I call the wrong side of the triggers, the advantage of rule number 3 is no longer in play. And you don't know if the market's going to continue up. You don't know where it's going to continue up. You don't know when it's going to continue up, guys. And this is where the market shouldn't go. And any lines outside of those triggers, these are not a part of the entry sequence. Go in the other direction. Large chart rules are met. The trend is down. The momentum is down. The path is clear. And you guys are waiting for a reversal bar. You're waiting for a fight on the small crowd. Remember, all of this happens inside of one bar on the large chart. Reversal bar begins the pullback, is not your entry, but you're going to define through trigger lines where that retracement is most likely to go, and you're going to define by areas inside of that retracement zone where the market is most likely to bounce and continue with the trend, and your limit order goes just below that lowest resistance inside of those triggers. And anything on the wrong side of the triggers, it doesn't matter how many fibs, it doesn't matter the one-to-ones that are up there, guys. The advantage of rule number 3 is no longer in play once you get to the wrong side of the triggers, once you break through the retracement zone through the areas most likely to create a bounce. And you're going to be able to use that concept. You're going to be able to use your study to define great entries, to define where the market should not go. And this is going to be your initial stop placement. And you're going to have this in the plan that I give you, guys. If price pulls to resistance inside of favorable large triggers, I'm in that trade. But because I can identify where my advantage is gone, my initial stops are going to be placed where the market should not go, 4 to 5 ticks beyond the triggers. Which is it, Mark? Is it 4 or is it 5 ticks? You choose. It's 4 to 5 ticks. I typically go 5. I like to give it a little wiggle room. Some people don't want to. They want to do 4. Guys, if they break through all of the good stuff that typically stops it, you don't want to be in that trade anymore. And anything that wins 70 to 80% of the time, guys, it's obligated to lose 20 to 30% of the time. Losses are not failure when you're following rules, guys. Losses are a cost of doing business. They're a very normal part of a positive equity curve. So stops go where the market shouldn't. And that's really it. That's the high probability trend trade. It begins with defining the trend. So every time I look at my large chart, I'm going to define the trend. And then I just go into the rules like it's a flow chart. If I have momentum, well, then I'll look for a clear path. And if I have a clear path, then and only then will I look for the entry. And you can go back and start studying these looks, guys. You don't have to take a trade. Your charts go back 10 days. 10 days of historical where every time you see momentum and path, or at least the potential to break, you can circle a tail. And what are you circling? You're circling what you hope is a pullback to an area inside of triggers. And if that tail lines up with rule number 3 being met, guys, this is your pattern. You're going to take that picture and you're going to start committing that look to memory, that look of momentum, how to define a clear path, and exactly where the market comes in. And some of the common challenges that people have. First, this is where the market's trading. Let me turn that into an arrow again. When it's time to look for an entry, your momentum and path, the market's all the way up here at 97.05, which means that you have a whopping $80 worth of profit before you hit that divergence high. And new users start saying, oh my gosh, I'm too close to a termination condition. I can't take this trade. The reality is that line isn't a termination condition until price reaches it. And we're not trading from the top of that bar. Top of the bar is the beginning of the pullback. You guys will be trading from the areas inside of favorable large triggers, which means from your entry point, you've got about $300 worth of profit. If you jump in early, your stop still goes where the market shouldn't. All you've done is decrease the distance to profits and increase your risk. If you get faked out, you don't get your entry, and they give you that little head fake and you jump in at the top of this bar and you're all going to do it, we have all done it. All you've done is shorten the distance to profits and increased your risk. Guys, great entries create manageable trades, and that's what I want you to focus on, is finding the best entry. Commit 30 days to finding the best entry. And let's go back and take a look and see what those circles look like. We're going to take this one first. Strong bottom, odds favorable. And guys, it never really makes it to the mid-band, does it? Never quite reaches that area. And then 3 divergences right at an area. And guys, sure enough, the area, even with potential, it doesn't break and the market sets down. Let's go back and find another circle at 829. This is that patience piece, guys. You're going to realize that there's 30 or 40 minutes in between circles sometimes. Odds favorable, momentum, potential to break, room to trouble, pull back to mid-band in the retracement zone. I think that's the one somebody in the room posted, and they took it right to resistance, right to the area that could stop the market. So in this picture, you're defining the advantages, where the market is most likely to continue. You understand where the market is most likely to go, taking profits, and then choosing to exit rather than hope that the area breaks with all the triggers below. Back it up again. So 13.2 chart here, Tucky, this is where the advantages are, right? 13.2 says smalls below the large, potential to break the areas. 5.1 says pull back to the area inside of favorable large triggers. I want you to see this circle. If I put that circle over the top of that tail, it lines up with the area inside of triggers. Does that make sense, Tucky? So what are you doing? You're defining what it looks like on the large chart when it's time to go find the entry on the small chart. Look at all that momentum. Look at that potential to break. Look at that pullback to the mid-band right in the retracement zone. Pretty cool, right? Back it up. Same pattern over and over, and then that was all the consolidation. So large charts up, potential to break, and guys, look at that. I've got a fib right inside of the retracement zone. So this is kind of what it looks like in the moment. Odds favorable, momentum. Oh my gosh. If they hit that red line, dang it, I've got to cancel my order. Now they're into a termination condition. If they had pulled back, we had a spot. Does that make sense, Tucky? So now the large chart's showing me weakness. Now the large chart hasn't broken through the areas yet. I'm in a holding pattern. I'm just doing nothing. There's a pullback to an area in the retracement zone when those one-to-ones had the potential to break. This is your pattern, guys. Over and over. And it repeats itself on different markets. It repeats itself if you use different time frames. So this is crude oil. Momentum and path. What does it look like on the small chart? It's the pullback 2 ticks below resistance inside of favorable large triggers. You took that one, Lonnie? Nice. There it is again. Large chart leads the way, says look for an entry. Small chart shows you where the entry is most likely to occur. Let's back it up. I mean, that's pretty. This was right when the futures markets opened in Europe. Strong bottom, termination, reverses, odds favorable, clear path. What did that tail look like? Backing it on up. Oh, there it is. There's your mid-band right inside of triggers, and all the momentum carries it up. There was your first opportunity. So guys, all we've done is define momentum. Now we can define path, and we don't have a clear path. But if those two are present, we're going to look for an entry, guys. That's all it is. It's just a pattern. So here's how you get good at this pattern. Take pictures. Take lots of pictures. Take pictures of strong triggers. Take pictures of weak triggers. Take pictures of a clear path. Take pictures of termination conditions. Snap that photo and annotate the chart. This is why it's strong triggers. This is the rule that it follows. And what happens is you're going to take those and you're going to drop them into here, guys. And if you go through and you take 25 pictures of strong triggers, you're always going to know what strong triggers look like. You're always going to know which rule it's met. You're going to know exactly what you're looking for to get you to that next rule, guys. And it's the idea that repetition creates recognition, that when you see the same thing over and over, when you practice the same thing over and over, when you create that neural connection between what your eyes see and what it means to you through the words that your brains hear, guys, this is how you find the advantages. And the core advantages are strong triggers and path. And once you have those two, you're going to find more opportunities. So take a lot of pictures. And as you take those pictures, here's your cheat sheet. So this is the high probability trend trade checklist, guys. Is the market coming from a strong top or bottom? Not mandatory. It is not mandatory to come from a strong top or bottom. But if you do, it's the highest probability trend trade you could ever take. And a strong top or bottom is a termination first that reverses the market. Do you have momentum? Or is it weakness? If it's weakness, pump the brakes. Wait for momentum. If you have momentum, it's a flow chart. Do I have a termination? Is it only the potential to break? Or is it actually a clear path? This is the one we're looking for. Define your entry, guys, because great entries create manageable trades. The second page is just a checklist. Print it out. Put it on your desktop. Is the market coming from a strong top or bottom? These are the questions you should ask yourself out loud every time you look at a chart. Where is the market coming from? Do I have strong triggers? Do I have any termination conditions in the way? If the answer is yes to all of those, my rules are met, I have to go find an area inside of favorable large triggers. Brand new users, if you start writing these rules on the chart every trade you take, you'll never need to policing. You'll know exactly whether or not you're following your rules. And the more you see these written on the charts, the easier the patterns become. So print that out. Nobody in the history of that checklist has ever been able to use it and do worse than 70%. I've had engineers try to beat it up over the course of like 400 days. They were in the low 80s. And that leads me to the KISS plan, guys. The Keep It Simple Sunshine plan. And this is a stepping stone in your learning journey. And then I'm going to owe Ron a nickel for this one, guys. The high probability trend trade is not your get-rich trade. It can be, but for most people it's not. The high probability trend trade, this is the trade that teaches you to see the other trades. This is the trade that teaches you to read the indicators so that you can manage the trade, so that you can be aggressive, so you can be assertive. This plan is designed to optimize your chances of success with a high probability trend trade as a new user. There is no tariff. The factory that builds that comment is located in Texas. Therefore, I get a break. Guys, it's going to be through simulation, through study, through class feedback, continuous practice. That's when you're going to be able to craft your own plan, guys, and it's going to be tailored to your goals, and it's going to be based on your ability reading the indicators. Oh, I know. So there's two things you need to know before you're not on simulator, guys. When you're on simulator, blow it up. When you're on simulator, take all the trades, but annotate the charts and talk about why you did it. And you may stumble into the best trade ever inadvertently by talking through advantages. But you need to enter because your rules are met, and that's got to be a focus because your rules are describing a pattern. That's all it is. It's a repeatable pattern. It's a testable pattern. It's a pattern that's going to be proven by you if you go back and circle those tails and write a couple rules on the chart. And what you'll find is that you can't wait to enter the market when the rules are met. You're excited to enter that trade because you know that trade is going to win more than it loses. You've proven that it does. And you're going to say to yourself, this is a pattern that typically wins 70 to 80% of the time. And I know I'm going to lose 2 or 3 every 10. And I just don't care if I lose as long as I'm following the rules. And guys, by following rules, you pull so much of the emotion out of trading. And then you have to know why you're going to exit. Another emotional roller coaster for new users, guys. Exits are taken at profit targets, whether they are predetermined or they're at key areas, whatever they are, or when your advantages are gone. When the advantages that get you into that trade are no longer present, it's okay to exit a trade. Sometimes you'll exit with a small winner, sometimes you'll exit with a loss. If I enter at the area inside of favorable large triggers and the market pushes 4 to 5 ticks beyond those triggers, guys, I'm taking an exit. I'm losing a little bit of money on that trade, but I'm not going to sit and hope, because hope rarely works out as a trading plan. So define your entries. We spend an hour every morning learning how to get into the market, learning where to get into the market, learning where our risk is the least and our profit potential is the highest, guys. The best of the best, the highest probability trade I could ever teach you. That's all we've gone through. And then once you're in, you've got to manage it. You've got to do something with that amazing entry. And that's where the KISS plan management comes in. And guys, I wrote this to be the most basic, emotionless, if-then scenario you could ever have as a brand new user. So as mechanical as your entry is, let your management be just as mechanical until you get some reps in to read your charts. It's based on 2 contracts. And each contract has a very specific role. The first contract is designed to teach you how to get paid, to accept profits. The second contract is going to help you learn to trust the large chart. But the whole KISS plan, those 2 contracts are designed to help you understand and trust stop placement, to be willing to put your stop where the market shouldn't go rather than where you hope it doesn't go. And it's focused on getting you paid. There is such a reluctance among new traders to exit a position because that little devil on your shoulder says, yeah, you could get out here at trouble, but what if it goes further? Think of the money you could make. And I've watched people get back so much money. So your KISS plan, this management plan, is 100% dependent on your ability to enter. So focus on entries for a little bit. If my entry is 2 ticks below resistance inside of triggers, as defined by the high probability trend trade, then my initial stop is 4 to 5 ticks beyond the triggers, guys. And that's it. That's where the market should not go. And I'll know my risk before I ever enter a trade. You'll know your risk before you ever enter a trade. You have to accept that risk. Because if you try to put your stop inside the retracement zone, if you try to put your stop below areas inside of triggers, it's likely to get hit. That market's likely to run without you. Targets are predefined at $100 and $200 in the KISS plan. If they don't stop you out, it means you're getting a reversal bar in the direction of your trade, and now you're going to redefine where the market should not go, and your new stop is 2 ticks above that reversal bar, because that reversal bar is confirming that now the market is going down from the area inside of triggers with all that momentum and clear path. And you're going to reduce risk. And that initial risk that you had of $150 per contract is down to $30 per contract. And that feels good. And that makes it easier to hold for the first target. If they don't stop you out and they go to the first target, that's $100 in your account. The first contract is pulled from the trade. It's out. It's done. The money's in the account. Your palms aren't sweating. Your heart's not racing. You're a winner. That is success, and success breeds confidence. And now you're going to put your stop at break even. You're going to take all the risk off the trade. And this is where you're going to learn to trust that with momentum and path, the market is more likely to push down than it is to go back up. And if they don't get you break even, it means that it goes to your second target, guys. And your second target is only $200 away from your amazing entry. And that's a $300 trade, guys. That is a $300 moment in the day. That is 2 to 3 minutes of your life producing $300. And guys, if that's the best you do every day is $300, congratulations, that's a $75,000 year. Find a way to throw another 100 in there. It's a 6-figure year, guys. So profits are important. Consistent profits are extremely important. Finding a way to make $300 to $400 to $500 a day consistently. Once you can do that, guys, the sky's the limit. There's trade copiers. You could take $500 a day, mirror it on a second account, and suddenly you're making $1,000 a day. And it's not because you're trading more trades. It's because you're taking the best trades, the absolute best trades. So one of the things I promise every morning is that I'll give you everything you need to be successful with the software, guys. So now you have rules. You have rules that have been proven to win more than they lose. You have a platform to get feedback on everything that you do as you learn these rules. You have a spreadsheet where you can track your progress, where you can see client trades, where you can see the basic rules broken down, and you have a way to study. I just dropped a zip file, everything you need. And everything that we've just talked about in the last hour is in there, guys. The only thing Nexgen doesn't give you is seat time. The only thing Nexgen doesn't give you is the repetition for it to become easy. That's on you. That's where you get to work, where you start taking pictures, where you start posting pictures. And the second half of class is dedicated to your pictures. So as we get into the second half of class, this is where I remind you that everything that we do is about a foundation. Everything we do is about having advantages. It's learning the basics. It's growing a little bit each day rather than hoping to be super trader in your first week because you stumbled upon Nexgen, guys. You have the world's greatest hammer. Now you got to learn how to swing it so you can build something nice. So for you new users, you guys that are brand new, that are learning to read indicators, guys, I blanket you with very conservative rules and focus on recognizing advantages. And I give you a solid plan that optimizes your chances of success as you learn to read your indicators. So for brand new users, all termination conditions are bad, and no momentum is bad, and anything beyond the triggers for entry is bad, guys. These are blanket rules because they increase the likelihood of your success. And your success is what creates confidence and gets you motivated to study, to do more, to wait for the best, guys. These things aren't always bad. And until you have the experience to learn how to adjust your plan, it's just better to avoid them. But you're going to see people in the room trading in determination conditions. You're going to see people in the room trading without momentum. You're going to see people going counter trend, Ron. And what happens is they've learned these trades and they've recognized these patterns from the study that they did on the high probability trend trade. From speaking to themselves in terms of advantages, they begin to recognize more. And when you recognize more, you find more. So learn the process that yields the results. The results come from simplicity initially. That's where the KISS plan comes in, guys. Keep it basic, follow rules. Be okay looking for the best trades, not all the trades. And you can find an extraordinary level of success. I've seen it for years. And the further you deviate initially from the KISS plan, the longer it takes you to get comfortable, to get confident, to see the best of the best. So question everything as we move forward. If you're uncertain, ask a question. If you have a hint of doubt in your mind, ask a question. Don't hesitate. My job is to answer every question that you have. And if I don't have the answer, my job is to find the person that does and get that answer to you. So as we go into the second hour and we start looking at these trades, I'm going to go back to momentum, path, and entry on every chart posted. I don't care what kind of trade you're taking. We're going to talk about momentum, path, and entry. It is my pledge to you that I will celebrate all the victories, but I won't hesitate to point out challenges. I won't hesitate to point out if I think you've gotten lucky, because luck is a short-term victory that typically creates a long-term success. The focus is on patterns, guys, the same patterns. Successful trading is boring. It really is. But the people that do the least, the people whose entries look the same, the people whose exits all resemble one another, those are the people that are finding success, the most success, the fastest success. So I'm going to take a break. Let's do large chart read. Crude oil. Odds favorable momentum, not a clear path. And the small chart is showing you how that not a clear path creates a big ugly bounce. Smalls are below the large. The colors don't match. There is a clear path to the upside, but no momentum to push it. There is not a clear path to the downside. Guys, you're in an indecision zone. And look at what the small chart is doing. when the large chart is fighting right at the key areas. There are ups, there are downs, there are divergences, and it all seems to be splitting a fib and a divergence high. Do you guys see that? This is the fight. This is the fight that you don't have to be a part of. And man, if you caught that bad boy and made some money, you don't care about this fight. This is where you go refill your coffee, scratch the dog behind the ear, and say, if it goes up and I get momentum, I'll take a long trade. If everything rolls, I get momentum and a clear path, I'll take a short trade. But until momentum and path work their way into my life, I choose to do nothing, guys, because it doesn't cost anything to be flat in the market. I'll be back in 5 minutes. Go stretch your legs, post them if you got them, and we'll start looking at the charts you guys pasted and posted. And then we will do Trading View again today, guys. We're going to go through it. We'll walk through it. You'll find that I get more comfortable every day we do it. You will too. Back in a minute. All right, cool kids. We are back and going to start posting or start looking at pictures that are posted. And just by the volume, I'm going to say probably not a lot going on in the market. Andy, the first one in the room, Trading View, right? Pull back to a mid band. Hit buy here, anticipation of this next move. So Andy, I don't know what your 15-minute looks like, but close above the small triggers, right at a trend trade spot, right at an HVA. Assuming the large trigger's not trading into zones, dude, that's the perfect trend trade look. How similar is that to Nexgen? Just a little bit of patience on the entry. Nice job there. I'm excited about seeing you guys post in TradingView. I'm excited to help you guys through that process. And then another one. And Andy, I don't want you to be afraid to click those arrows and get all this writing off your chart. It'll make it easier. You went long. Little bit of a fight there, Andy. Little bit of a fight there. You have to reset the time zones on TV. You don't have to reset the time zones on TradingView. So Andy, because the time zones has to do with the servers for Nexgen. No, it doesn't have to be. It can be anywhere you're at. It doesn't matter. Probably starting next week, Joel. But Andy, just a little cleanup. If you see all of these, you can hit those arrows and they get it up. It should be set to your computer, I think. The volume down at the bottom, there's an indicator that's a volume indicator. You can remove it if you don't want to see that volume at the bottom. Little things that you can do to clean it up. I double click on my indicators. And the one thing that I like to do, and this is just me, is I take labels off in the price scale. Because I don't want to see a million different lines here, different colors. I like being able to see where the price is. Those are some of the little cleanup things that I do. But I have a little bit of OCD. Like, I don't like seeing every highlighted line here. Volume's cool. I like it. And you're okay. So why did you go long? So when you're annotating and you're learning this stuff, Andy, just say why. That's it. Why did you go long? Well, there was a mid-band, and I saw large triggers up here, and I got in on the right side of the small triggers, and I figured I could take it back to the large triggers. Right? So write your plan. Write what you're doing. Tell me what you see. And then that way we can go through and we can start refining a little bit and getting you focused on the advantages. Great stuff there, though. And then back to Old Faithful, right? Odds favorable. Oh, you got the trigger looks back. Now you have momentum. No, it's okay, but there had to be something going through your brain, right, Andy? What was the why? What made you think that a long trade was the right trade there? Here you thought it was a long trade because you had momentum and there was a divergence. And you had a pullback to an area inside of triggers, right? So here you can define exactly what you were seeing and why you would take that trade. So as you start with something new, and this is for anybody, as you begin to go through and do new things, your whys, they don't have to be rules. They can be saw a mid-band, went long from correct side of smalls, right? And that's your whys. And it may not be rules yet. So what we do is we take your whys and I say, okay, you had a mid-band here, but you notice that you're coming off of areas. Do you notice that the momentum is down and the trend is down? And man, this is a termination condition that's pushing that market down. And right here, you had a beautiful trend trade to go with everything. And as the mid-band comes down, you have another beautiful trend trade to go down with everything. And then when it finally hits the mid-band, that's where the bounces happen. So what we're going to do is we're going to take your whys and we're going to slowly mold them into rules following. Does that make sense, Andy? Same way we do with Nexgen. Because it's Nexgen. Well, you had a mid band and you had a huge gap to those large triggers, and you got in on the right side of things from the outer band, and you had a lot of reasons that this might work. And we just want to identify them. Well, I want to know what your thought process is. Because hell, Andy, you might be creating the next great trade. I might need to steal it from you. And your whys will help me do that. You're just writing a recipe. That's all it is. You are Superman, all right. But you're just writing a recipe. And when you guys annotate charts, you're writing a recipe for success. You're saying, man, when I have a strong bottom, when I have momentum, when the path is clear, I'm going to find an entry. And since it didn't get my entry, I'm going to jump in and try to catch the second half of this trend trade. And I'm going to make some money because money is good. And then when it doesn't reach my entry again, I'm going to ride that momentum and path, large chart, and I'm going to find a way to get paid. And beautiful job, Bob. And everything on his chart, guys, all of his success, I can't stress this enough, stem from momentum and path. Momentum and path is the recipe, guys. Momentum and path is exactly what leads the way. And you did a great job with it, Bob. And then Andy, strong bottom, odds favorable, potential to break, perfect entry, just rock star. Absolute rock star. Nice trade. Great opportunity to get paid at trouble. I love it. Nicely done, Andy. Great look. All right, and now we get the Bob Show. All right, why you took this trade? Strong top. Well, no, it's a termination condition, Bob. Because the only way it can be a strong top is if the large triggers roll. Does that make sense? So right now you've got a beautiful termination condition. You've got all the divergences telling you, hey, this termination condition is definitely more likely to hold than not. Your small triggers roll. This is an important part of it. And everything starts down from that termination. And you say, I don't want to trade into this line. That line could ruin stuff for me. That line could stop my fun. That line could create a bounce. But with momentum on both of these charts, with the small triggers down, I'm going to ride that momentum down. And this is beautiful. And there is no HVA sell indicator. So Bob, when you start talking about high volume area trades, it's that physical line. It is that, no, you're good. And I know you are, so I'm going to go through and help you because it's fun for me. So when we talk about the HVA line that you're buying or selling, Bob, it's a green line from lows. It's a magenta line from highs. And you won't always get one just because there's a termination condition. So when you look at it, there's HVA momentum trades. The third rule is literally buy or sell the line. And from a high, it's that magenta line. And from a low, it's that green line. And if it's not there, guess what? It's not an HVA trade. But the great thing is, Bob, is you had a termination condition. It was confirmed on your 5-1. It was confirmed on your range chart. Small triggers roll, small and large roll, small and large roll. So what do you have? You have an awesome looking termination. The small charts have showed you change. The momentum is strong, 2 out of 3 charts, and you ride that momentum down. I love everything about this trade. And I love the patience to enter on the other side of the fib instead of trading into the fib. Because fibs can create bounces the same way they did there. And once you got south of it, nothing in the way, all this momentum, that market had no desire to stop and you got paid nicely for it. Really well done, Bob. And I'm going to do that. Don't get upset. Someone said don't trade into terms. I should have listened to them. So don't get upset if I'm telling you that your HVA trades are not HVA trades. High volume area is what HVA stands for. And Bob, you're not even showing me a range chart. What you have is strong trigger. You have a termination. Everything rolls. That was your first trade. And then with odds favorable momentum and nothing in the way, you just jumped in. Just JTFI and rode that momentum and path all the way down to fibs. What an awesome trade. But it has nothing to do with HVA. You don't even have the chart up. This is momentum and path. And Bob, this is one of the things that happens. And this isn't just for Bob, guys. This is for everybody. When you start learning new trades, you're going to have new terminology. You're going to have new rules. Make sure you're not confusing them. This one had an HVA line. So Bob, your entry should have been the pullback to the pink line here. That would have been an HVA trade. Late entry. And then you're out of trouble. Absolutely beautiful. And then this is just momentum everywhere. And you jumped in. But Bob, can I show you an awesome market flow chart pattern? Do you notice with all this momentum, you get an up bar and then you get a down bar. And with all this momentum, you get an up bar and you get a down bar. And with all this momentum, you get an up bar and you get a down bar. This is a pattern. So if you wanted to hold this trade because your large chart said we're going, because your small chart said we're going, this is a pattern that I'll get an up bar, and you see the box around this bar, and the box starts up here, and as it goes down, I'll follow it with my stop. That's my new stop placement, and I'll do the same thing here, and I'll do the same thing here. And now I'm using that pattern, that up-down pattern with all the momentum to help me just stop spending money on commissions. Does that make sense? And as long as you have odds favorable momentum on those charts, that helps a lot. It's a good pattern. Go back and look at it. And now I'm realizing that I'm going to have to build some range charts so that we can do it. Awesome job, Bob. But remember, every chart has rules, or every trade has rules, and it has rules for entries and rules for exit. And if you begin to confuse the rules, you may not manage the way you're supposed to. So here's crude oil. No, and that's great, and you're killing it. And let me build a range chart for crude oil real quick. Because if this is going to be a topic of discussion, I want to make sure that I have that tool available so that I can teach you to the best of my abilities. So give me just a second. And I'll build an 8 range real quick for crude oil. And we'll be able to go through and look at some of this stuff. While that is loading, I'm going to scroll up and we're going to find the next pictures. Bob, I appreciate that you're learning something new and giving me a chance to help. One of my favorite things to do. Odds favorable, haven't reached trouble, jump in. Oh, they gotcha. And then you're like, that's my money. So you just keep riding it down. Nice. Getting paid. And then just doing it again. Just a whole lot of momentum. And Pete's finding a way to capitalize. Whole lot of momentum. Pete's finding a way to capitalize. That big fib at 59.80, you'll notice that there's a little break in the action there. Nicely done, Pete. See where we're at here. You've gotten back to it. So Pete, you've gotten back to trading right at the fibs that could be problematic instead of letting them break. This one worked out great for you. You were avoiding this for about a week, and it worked its way back in. Not saying it's right or wrong. I'm just saying that I noticed that you were avoiding it, and now you are no longer avoiding it. So you must have done a little extra research. Price moving up, wide, divergence helping push. Beautiful entry. And out at trouble. Great trade, Cav. I think this is the one we looked at earlier today, too. Really nicely done. And I'm going to take my crude oil chart real quick. I'm going to back it up. Make it a little easier to read. I'm going to put this chart in the middle of it. And then because I know you guys are working HVAs, I'm going to drop an range chart next to it. And this is how you're going to study it, Bob. You're just going to come back and start looking for correlations to see if rules were met. But the only way you can have an HVA trade is if an HVA line is present. And we'll do some work on those. We'll play with those. We'll study those a little bit. It'll be fun. All right, Tucky, are you still in here? We're going to revisit. Did we answer the question on when it's time to look at the small chart? And let's go back. And one of the things that happens, and this is for everybody, not just Tucky. So your large chart in this instance had a termination that reversed the market. That's a strong bottom. And this is where I want you to look, Tucky. Do you see this bar right here? Price hadn't reached resistance yet. Can you see it? Your small triggers have absolutely smashed through this Fibonacci area, but the large triggers are still behind. So right here, this market has all the momentum and the potential to break, Tucky. And there's your pullback to the mid-band, right there at the triggers, to take it up to trouble if you were going to take it. So that was your trade. That was your 50-50 trade. And what happens is the more you focus on advantages on the large chart, the more you focus on what it is you're seeing over here, it sets you up to catch these on the small chart, because this is just an entry chart. So Cav said, check it out. I've got momentum. I haven't reached the areas. There's a mid-band in the bounce, in the retracement zone. Let me ride that momentum up to resistance. But you see how this chart said, let's go to this chart? That's the beauty of you having the big and the small. Because the big chart, it's hard to see change on. For example, let's go to the S&P real quick. Inside of this one bar on the big chart, and let me know if you see it. Strong bottom because it reversed, odds favorable, potential to break. Do you see? That's your large chart read right here. On that one bar, you're getting all of that awesome information. If that were your most current bar, you have all that amazing information, guys. That's all it takes on a large chart. If you back up to the small chart, you can see that inside of that one bar, there's a reversal bar, there's a full retracement, there's a bounce off of an area in the retracement zone, and there's continuation up to the next area. So in the large chart, that slow chart, good morning, Miss Cindy, says check it out, momentum, potential to break, life is good, let's look for an entry. Your small chart is right here. And what we're going to do is we're going to say the large chart is so good, let me pinpoint where it's most likely to bounce on that small chart. Let me enter the market and let me ride that momentum up. And all of that's going to happen in this one bar here and in all of these bars here. So if the large chart leads the way, if you truly let the large chart lead the way, if you really insist that it has what you need, the small chart will help you find a way to get that entry. Does that make sense? I wanted to revisit that question. And it's that refinement process on the small chart that lets you catch these really awesome trades. And sometimes it's not a trade in that case. Really good stuff, man. And look at the fight, guys. This is shenanigans and nonsense and buffoonery. And it's all happening right at key areas where decisions are made. These are some of the best lessons, I think. When you just have nothing to do, when the rules just aren't met. And if you sit on your hands long enough, you'll see why we follow rules. And you'll begin to understand why it's so important to have these advantages. Because it's not necessarily the winners they produce. And I love the winners that the methodology produces, but it's the losses that adherence to the plan can help you avoid. And we talked about this one, right? Bob, it was because we didn't see the large chart, but what do you think about this, Bob? Odds favorable momentum, up bar, down bar. Odds favorable momentum on both, up bar, down bar. That's a pretty cool pattern. That's a pretty cool pattern. That's one of the patterns that I'll use for management to hold. When my big chart's screaming in the direction of everything, but I don't want to leave a $4,000 stop, I'll use this pattern. And it's not an HVA trade because it's not a strong top. But here's the deal, Bob. Let's talk about what an HVA line is. I like this. This is fun for me. I get to kind of visit some stuff that I don't get to visit that often. Let's talk about what an HVA line is. Get down there. And I'm going to just open this up. And we'll do it like this. So I can get both directions. Because both are coming off of termination conditions, right? So in order to create this HVA line, two things have to happen. The first is you have to get what's called a breakout bar. And let me make that very visible. And the white bar is the breakout bar. And what this is saying, Bob, is that despite all of this, right, these up downs, these down bars, finally they get a breakout bar loaded with nothing but buyers. Does that make sense? This is the one that says, we think it's going to hold. F yeah, we're holding. Well, see those two lines on there? That's the high volume area of a bar. That's where the highest concentration of sellers, highest concentration of buyers. This is your high volume area. It's just what the name suggests. Well, when you take the high volume area on a breakout bar and it's followed by another bar in the direction of the trade, Bob, that's what produces this green line. And this green line, this is the way I like to think of it. This green line is the line in the sand. And this green line is where there was such a high concentration of buyers that the buyers are saying, I triple dog dare you sellers. We had a strong bottom. My triggers rolled. I broke out. This is exactly where the concentration of all of us, this is where our gang hangs out and smokes cigarettes. And if you come back to it, we're going to push. And that's what creates the high volume area trade. And I think about things a little abstractly. I know that I do. But that's exactly what happened here is we had a termination. And then somewhere, there it is, you get the breakout bar. But look, the next bar is not a down bar. So there's no HVA. But when you get the down bar, there's the line in the sand. There's the buyers testing it. There's the sellers. Get bent. We told you that's our spot. And that's why the high volume area trade is so effective. Because you couple this line in the sand with a key Fibonacci area that said not only are we stopping you, we're reversing you, and we're drawing lines in the sand. And if there's not a termination preceding it, Bob, that HVA line means squat. And you can see how they just ran it over. But if everything's going up and the buyers are in control, that's a great spot. And then if it's not in control, that HVA line means squat. The sellers took it. Does that help? Does that make sense? I love thinking about stuff in these terms. I love thinking about stuff in what are the buyers and sellers doing, right? Well, there's your termination, and it started to push up, and there's your breakout, and there's your line in the sand. Man, that's a lot of momentum down, right? Could we buy that HVA line? Termination, triggers rolled, pull back to the HVA line, and watch this. They're pretty low risk. If they make a down bar through, I don't want it. So one of the cool things is I might get stopped out. If I don't get stopped out, this box is going to start working its way up. I'll chase the box with my stop. I'll keep reducing risk on this trade. But is it rules met? Termination, triggers roll, pull back to an HVA area. That's your trade, Bob. Live and in front of you. Couple things that have to happen. You have to have room to targets, right? You can't run head first into stuff. Stop goes behind the reversal bar. Pretty cool. Large chart leads the way. Small chart shows the change. Buy the HVA. Doesn't guarantee a winner. But these are rules that have been taught for a long time. And, you know, this is the KISS plan management. Maybe I say, I'll take the second one off because it is counter trend, just below Fibonacci resistance. And I might say, you know what? That's my first trouble spot. I'll try to take my first contract off at a fib. We'll see if it breaks to go to the second fib. And this is where you start asking yourself, so what's changed in the trade? Nothing, right? I've got 3 divergences from a low. I've got a termination. I got some stuff that could create some sticks right here. But my small triggers are up. My large triggers are rolling. My large are up. My fast are up. The HVA held. I've got virtually no risk. I've got 6 ticks per contract. That's your trade, Bob. This is what you're studying, but it's the accumulation of all 3 charts. Does that make sense? I love that one's set up live. I love that we got a rules-based trade live. And it may not be a home run trade, but the rules were met. You're still fighting strong triggers. And Wayne, yours was exactly the same yesterday. All right, let's go to the next chart. Bum, 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 bum. Sound effects make it better. Pete. There it is. Large chart still good. Broke through all the terminations. And Pete says, I'm just going to find a way to capitalize. Momentum and path. I'm going to find a way to capitalize. I love it. Awesome, Bob. Okay. I circled the tail. You did. It is definitely counter trend, Jen. It is definitely counter trend. What's it doing? We're still in it. So Tucky, you did circle a tail, didn't you? Are you with me? This is such a good question. This is such a good chart. Did you have odds favorable momentum when you circled that tail? No, not at all, right? The market is down, the triggers are down, there's no momentum, everything says down. Just because there was a tail doesn't mean that there was a trade. So Tucky, the tails that you want to circle need to have strong triggers and a clear path. You're circling tails when the large chart rules are met. All this is the market changing direction, not at all a trade. Does that make sense? The tails we want to circle, and let me drop the picture in the room for you. The tails that you want to circle to study this, it's this bad boy right here. When the rules are met, circle the tail and see if it lines up with areas inside of triggers. And we don't trade the tails, we trade the pullbacks to support or resistance inside of triggers. So awesome picture, and about halfway to where you need to be. Tail circle should have been one right there, probably one right there, potential to break right there, and then a lot of sitting on your hands and waiting for things to sort out. I hope that made sense. Great stuff, dude. I promise you, every time you post in the room, we're going to get one step closer. That's what we do. How's the HVA trade going? Man, they're making you sweat. Check it out, though. Those fast triggers are trying to roll up. That HVA line is held 1, 2, 3, 4 times. Pretty cool, right? You're just watching a fight. We knew there would be a fight. You could see all the bouncy stuff. All right, let me see where we're at. Lonnie, I almost missed you. Sorry about that. Strong bottom, odds favorable, 50-50. So here you go once again, Tucky. Look where his circle is. Right at the area inside of triggers and trading that KISS plan, Lonnie. Nicely done. And Lonnie, great job getting back at it. I know you took a step away from it. I know you got a little smarter than the plan because you were feeling confident. And now you're back at the plan and getting results. I absolutely love it. Financial suicide on the large chart. Oh, fighting strong triggers, Pete. Yep, those are strong triggers. Without a doubt they are. You have to take that into consideration. We were more focused on entries. This is an easier trade with weak triggers because it's hard to stop momentum. I love that you put that in there, Pete. Financial suicide on the large chart. Pete is referencing my favorite book. My brother wrote this. How to Commit Financial Suicide, One Easy Step. Yeah, but still strong triggers, right? Trading against strong triggers. And let me show you what it's like trading against strong triggers. I take a lot of pictures. I want to find one in particular. It may take a minute. But there is one picture in particular that I want to share with you guys. All right, I'm going to go to the Google Webs to find it. Fighting strong triggers is having this guy coming at you and saying something clever like, well, he had a stop sign. He was going 100 miles an hour, but he had a stop sign. I decided to walk out in front of it. It's like trying to beat the train, guys. So sometimes, Bob, when you're looking for HVA trades, you're going to have to use a little bit of discretion. You're going to have to say to yourself, holy Nikes, look at that momentum. Maybe I should let it settle down a little bit. Maybe I should let it recede before I try to fight it. Because when they're weak at a fib, the fib is more likely to hold. When they're really strong into a fib, it's more likely to get that retracement back and retest. Pete, thank you for saying that. That was something that I didn't even talk about, that I should have. So when you guys start looking for these HVA trades, recognize the fact that fighting strong triggers is still fighting strong triggers. Ron says, here's strong triggers, but it's into a termination and divergence from a fib, and I'm not going to look for a home run, but this is a pattern that that Ron knows. With a termination, with divergence, with the small triggers rolling, Ron can almost always catch a snippet back to the white bar, reversal bar marker. And it's a thing of beauty. And it's aggressive, and it's against everything, and it goes against everything that I teach. But if you guys had any idea how much study went into this trade, if you guys had any idea how much study goes into the trades that people take that seem to be aggressive, you'd understand that when you start reading indicators, guys, you'll find a way. You'll begin to see things. You'll begin to recognize patterns. All right, how would you have known to get in there? You'd have to talk to Ron, Bob. I don't teach you guys to fight triggers. Sorry. My job is to try to keep you guys a little safe. All right. Tucky, will you help me with some annotation on here? Do you have strong triggers on your large chart? What do you think? And we're going to answer your question through annotation. And guys, this is where we're looking. So let's do this. See if we can tighten this up and make it easier to read. All right. Have a good one, Cab. Tucky, are you with me? What do you think, man? Do we have strong triggers? Anybody in the room? This current bar, first bar. Yes, absolutely. What a great look, right? The odds are favorable for the market to continue up. But that's only the first rule. So now I have to say, do I have a clear path? All right, Tucky. So this is Tucky's chart. So Tucky says, how do I know if I should enter? So Tucky, you had strong triggers, right? I want to make sure that you're good. This is your chart. It's all right. No, you have the best strong triggers. Smalls are above the large, the spaces between. So that's your look, Tucky, every time. And here's the cool thing, is your strong triggers have nothing to do with Fibonacci areas. Your strong triggers have nothing to do with divergences. Your strong triggers have nothing to do with price bars. Your strong triggers, my friend, are one look. Okay, but we start on the 13.2, right? The 13.2 has to define momentum. So let me pull this up. And man, you're a rock star for sitting through this. Large chart will define momentum in rule number 1. Large chart will define clear path in rule number 2. Tucky, I don't give two squats about my small chart until the large chart says go. Does that make sense? So we're going to keep it on the large chart. We're going to focus on that one for a minute. Let me open that back up. So watch this. We're not even looking at the small chart yet. So strong triggers, yes, absolutely, 100%, right? But then we have to ask about the clear path. And I'm going to write the recipe for a termination condition here in the part of the chart that we just don't need. So a termination condition is price reaches resistance, in this case, resistance, triggers remain below. So when we talk about your clear path here, do you see how price reached Fibonacci resistance? How all of your trigger lines have remained below? This is a termination condition the way I teach it every day, Tucky. 100%, without a doubt, this is an area that could stop the market. The exact same way it did right there. Do you see it? So, did it pull back to an area inside of favorable large triggers? Absolutely. So these are your options. If I am following high probability trend trade rules, no trade. If I'm willing to break my rules and hope an area breaks, this would be my entry to do that. So this is where you have to ask yourself, what is my plan? Are you trying to follow the KISS plan? If you are, it's no trade because of the termination condition. Does that make sense? And that's one of the easiest ways to answer whether or not there was an entry. There's always an entry. Let me say that. There's always an entry because it doesn't take anything to pull the trigger and get into the market. Was there a rules-based entry? And that was crude oil, right? Let me look at the timestamp on that. 9:53. And what time zone is your chart in? Are you in Eastern time zone? Okay. So Tucky, I believe that was your trade into the termination condition. And that's why rule number 2 is so important. That doesn't look like yours though. But it's the same idea. And termination conditions are termination conditions because more often than not, these will stop forward progress. And more often than not, these will cost you money rather than provide you advantage. Does that make sense? And that's why we go through it and why I believe if you just keep it simple, give it 20 days, right? 20 trading days of keeping it simple, of identifying momentum, of talking out loud about the path. And then if these are good, then looking for the entry. What happens, Tucky, is it creates this awesome awareness of what the market's telling you. And it doesn't take you any time at all, once you get good at those two things, to say, you know what? My small triggers are up, but my large triggers are down. That's not momentum. My smalls are through the area, but my large are not. That's not a clear path. And you start saying things like, wait a minute. I shouldn't be looking for the short trade over here because I don't have the advantages I need on the large chart. And we'll go to the S&P. I've got weak triggers. That's my first part. And then I've got no clear path. That's my second part. So it doesn't matter what the small chart says. I'm not looking for the entry. Does that make sense? I love it. I love this lesson. This is that patience piece, man. And the patience piece, for most of us, and I'm raising my hand and scraping knuckles on the ceiling right now, the patience piece is the hardest part of being a day trader. Finding yourself okay not taking a trade because the rules aren't met. And this is a good example of it. It wouldn't be unusual to see new users say, but Mark, I had a pullback to an area inside of triggers. But look what the large chart says there, Tucky. Do you see it? So the small chart looks kind of sexy. The small chart said, dude, we're going down. This is just a little fight. And that would be an avoidable loss. And not trading into the termination condition, that would be an avoidable loss. And avoidable losses are amazing because when you're not giving the money away, when you're not losing trades that you shouldn't have been in the first place, it means that all the money that you're making off your winners, all the money that you're making off of those great entries, it's staying in your account, man. So thank you so much for the awesome ability for me to go through that. That's pretty good stuff. All right, we're circling tails, right? I dig it. 5640, 5640. So, Todd. This is Todd, right? I love that you're posting, man. That's all right. We'll get the annotation in there. Strong triggers, 100%, right? Great look. Termination, strong triggers, and 32 flavors of hurt in front of you. 5642. No triggers through. Yellow 1-to-1s, no triggers through. And this is a tougher look. This is a more difficult look to take. And it looks like you wanted to get in somewhere around 41, which is going to be somewhere over here. And it's a little more difficult, Todd, because you don't have the clear path. You have all of the momentum. You have a retracement zone defined. You have areas inside of the retracement zone. So if you chose to take this trade, if you chose to enter this trade and you were talking advantages, right? You would say to yourself, I absolutely have momentum. I without a doubt have an entry area, but my path is not clear. So you know you're working with 2/3, which means if I choose to enter, I'm missing an advantage. This is not high probability trend trade. I will manage assertively if the small chart shows signs of change. Does that make sense, everybody? And Tucky, this is a good one to go back to, is when you can start to go through these advantages. I have this, I don't have that. You may still choose to take a trade with 33% of your advantages gone, but the thing that I want you to have in your brain is that I might have to manage a little more assertively. I understand that it's not perfect. I know what I'm up against. I know where problems can happen, and if I see those problems happening, I'll exit the trade instead of hoping that the market goes up. Good stuff, Todd. We'll get you on those annotations eventually. Don't you worry. Joel, nothing to do. Wait for the fib to break or wait for the market to reverse. Perfect. Great termination condition picture. Steve, unbelievably incomplete thought. I don't know what it is. It looks like you went short at resistance with everything down and got paid. I love it. And now it looks like the system's waiting for waiting to enter if you get above trouble. And I know you're working on a little bit of thing there. Difficult for me to do much with that picture because it's such a small picture, such a small snapshot. But when we get the bigger snapshot, termination condition, reverses the market, odds favorable momentum, hasn't reached the fib, and you take the perfect high probability trend trade entry and get paid on the way down. This is beautiful. And you know what, Steve? I'm going to take this one because it does look different. because you made it your own chart, but it is the perfect high probability trend trade. It's just a different look, different chart look. That's good automation. So even packaged differently, whoops, even packaged differently, it's still just a high probability trend trade. Really nicely done, Steve. Thank you for sharing that. And I think that is a great segue as we get into the idea that even packaged differently, advantages are advantages. Momentum is momentum. Areas are areas, guys. And fighting is fighting. This is the S&P, and you can see the change happening coming off of that termination condition. And there's crude oil, and there's that same termination condition that we were looking at. It's okay. And there it is. And there's your HVA trade, Bob. Right off that bottom. And then if you missed it, there's your second shot, pulling back to a zone right with an HVA. And now we're into trouble, and it's okay to pause. Pretty cool, right? It's the same stuff. And you're okay on the labels, Steve. This is perfect. I can read it beautifully. That one I wasn't sure. This one, big chart, small chart, I can do that all day long, brother. All right, guys, I'm going to take 5 minutes, maybe 4, who knows. And when I come back, we're going to look at TradingView. And Wayne, I'll do my best to answer them. But remember, I don't work for TradingView, but I'll give you everything in my arsenal, man. So start typing them in the room one by one for me, or put them on a chart for me. And we'll try and get all of them answered. And guys, if we have to go over today, we'll go over today. Who cares? Let's get you guys all the answers you need. I'll be back in about 5 minutes. Give or take. back into it. So Wayne, this is the pop out that I have. So it's actually not even a browser tab. What I have is the, let me see. It's the TradingView app is what I have. So if you go to a browser and you type in TradingView app, this is the desktop application. And what this does is it pops you out of a browser. Just so that we can get to the same one. And let me answer the questions that are in there. Sorry, I didn't realize we had so many. You don't have areas like your screen on my trading view. You don't have these. So these are the zones, Josh. I'm just going to start and go down. These are the zones. This is an indicator. It's an add-on, and it's a purchase. So invite only. This is the chart prime. This is what John and I both run. I think it's $67 a month. But if you go to and you just search indicators, take care, Estefania. And if you search, I hope so. Supply and demand. There's a lot of good ones in there, and you can go through and find any one of these. And there's one, Algo Alpha. Let me take the picture. This is about the best one that I've found. It's a free indicator. So there's that for you, Josh. If you don't want to buy them yet, and let's just open a new tab real quick. And then we'll put favorites. I'll put that one on there real quick and let it run and you can see it. Tucky, take care, man. And then these will come up eventually. It takes a second for them to build. There we go. So there it is right there, Josh. That's the free version. Pretty solid. Look above you. Dynamic supply and demand zones, Algo Alpha. That's the free version. And then Andy, you said you actually did have the time zone. You're accustomed to Eastern, so you did Eastern also. Never scroll with the up and down arrows. It will change your charts to a completely different futures market. Mark on Ninja, the area you have called resistance, 1 minute, did not exist. It was just odds favorable on a large chart. Jen, are we talking about... Hold on. Were we talking about crude oil? Oh. Ignore your comment? Sorry. Pete had a fib? Okay. All right. Guys, I'm going to get all your questions. Don't worry. Momentum trade, nice. Okay, so you clicked there. Wayne, I love the way you do your questions. View mode only. No zones. Okay, so let's cover this one real quick. No worries, Jen. Yes, you need premium for the HVA lines, Gary. So when you go view mode only, what you're going to do, and let me show you exactly, let's go through this real quick to get you guys charts. And guys, remember, I'm new to this whole coming off the website thing too. So we're working. I'm going to go instructions, and I'm going to get us to where Wayne was, which is Next-Gen Trading View Indicators. Premium is the one that you need for market flow. Gary, I don't know about Ultimate and Expert. All right, so guys, when I click on a chart, we'll do gold because that's what you were doing. It opens up in my browser. And that's the gold chart. And mine has the zones in it because I pay for it. And then what you have to do from here, and Pete, I think this will be part of yours. So I get the workspace in the browser, and that's cool. This is view mode only. I'm going to click copy. And once I click gold copy, I'm going to save it. It'll reopen it, which is cool. But I'm going to open up Trading View. And then if I click a tab and I'm going to create that gold layout, I'm going to create a new layout. And then over here in my drop down, you'll see that gold, the one that I just copied. And if I click on it, it brings up. No, the zones do not come with it, Joel. You can buy some, or there's free options. I put a picture in the room of what we have found to be the best free option. So Wayne, that's how you get it over to the pop out. Pete, that's how you get them over to the pop out, to the app. Is first they're on the browser when you click them from the Next-Gen page. And then once you copy them, you're able to get them to drop down into here. And if you don't want to do the app, and I don't know why you wouldn't want to do the app, you could come through and I could click on the crude oil one the same way I copied it. And it brings up my crude oil one, and I could go down and I could click on my NASDAQ, and it's going to give me my NASDAQ, and I'm popping these up in all the browsers. And then Wayne, you said zones, right? So no zones. Did I answer that question on the algo? So to find that, I almost called it an appetizer, not an indicator. So to find that indicator, I'm going to click indicators, and I'm just going to type in supply and demand. And that's the one that I'm looking for. So just click on it. Once you click on it, it drops in and it starts running, and it takes just a second. So you literally just have to click on it. In any of the indicators that I use, I star. So I'll go through and I'll put a star on it so that I can get through and get it quickly. And then I can pull it off of there. But all you have to do is click on the indicator and it goes right in. It's an easy load. And then Roy, if the trading view already, how can you import the indicators in? Or do I have to download all over again? So Roy, did that answer your question? I know you're listening, and I should have read them all in order. From this link right here, Roy, you have every pre-made workspace that you need. So if you click on it, are you with me, Roy? I want to make sure that I'm not leaving you behind here. Awesome. So let's say you need an S&P chart. You're going to click View Chart, and that's going to pull it up for you in View Only mode. And then what you're going to want to do, Roy, is just go to Copy. And once you click Copy and Save, that workspace shows up right there. And then you can just drop it right in. And it's really that easy to get the workspaces. And let me know if there's anything I can do to help with that. So it goes from View Only and you copy. And then it pops you up here. and that's, I use the app. So in the app with Premium, guys, I have all of my workspaces here. So I've got NASDAQ, S&P, crude oil, gold. I've got XRP for my wife. And then if I need to do more, I can do more. I think you can have up to 7 with Premium if you need it. That's XRP. Look at the 1-to-1s in a zone. Guys, that is so powerful. And there's the zone holding, right? So it's just like fibs. It's kind of what you're used to with fibs. And then, Wayne, did that answer your question on the browser tab? I like to do the app. I like to do the TradingView app. So I can just pop it out and I can run all 4 in there, and I don't even have to work in a browser. I can watch videos about hot rods and pretty girls on a different screen. And then let's see what else we have. All right, so Pete, what would be helpful is to walk us, or at least me, through starting TV from scratch. So opening the charts, opening the fundy, connecting the two. For sure. And I think we're at that spot. I think I answered everyone's questions. So let's go through it. So I wake up, Pete, and I say to myself, you know what? Oh, yeah, no, cool. I'll just, does anyone have elevator music? All right, so before we do that, I'm messing with you, Pete. Let's do this real quick. I'm just going to start the slideshow. And this is where we are headed when Pete has time for me. Guys, we're going to go to the Nexgen Pro Trading Funder page, and this is where everything is. This is where you get all the TradingView stuff. This is where you get all of the workspaces. This is where you're going to hook in with everything to do what you're doing. And then, believe it or not, there's instructions. And I know that seems weird, right? Guys, instructions are a bunch of words on a piece of paper that tell you how to do something. Most of us avoid them. So you're going to start TradingView Data Connection Guide, and it's just going to walk you through it. Nice job. How to create a TradingView account. You're going to go to TradingView. You're going to click Get Started. You're going to go to the home page. You're going to sign up. If you already have TradingView, you're going to skip down to the live data connection. So you go through, you get in, you sign up. There's all your how to create a new chart, how to change your symbols, saving a chart layout, logging into your paper trading, logging into your CQG account. That's AMP. That's who you'll be using for live evaluations. Selecting live, connecting, all these things are there for you. You're going to establish your connection. So all of that, that's your data connection. And then when you're doing it and you're going through it, you're going to come in and you're either going to log in or you're going to sign up. So I'm going to do this real quick. I'm going to create a fake account. So I'm going to register as a new user, guys. We're going to go start to finish here. I'm going to register as a new user, and it's going to make me fill everything out. All the email stuff, all that sort of stuff. I guess those have to be numbers. Sorry. And then you're going to create a password. And when you create a password, I'll just do it like this real quick. just like you're registering or anything, guys. And once you register and you click register, uh-oh, that's the wrong one. Once you click register, it's going to go through and it's going to send you an email. And that email is going to say confirm your address with Nexgen funding. And when you click on it, you're going to follow and you're going to confirm your address. Thank you for confirming your email. You can now log in and you're going to bring it over and you're going to log in. And once you log in, whoops, these are all my test accounts. I log in and it brings you right to the dashboard, guys. So instantly, when you log in, you're going to go through and you're going to do the trader contract. John's going to kill me. So DocuSign, you're going to not adopt, you're going to initial, you're going to go through and knock all of this out. And you're going to finish it. And it's going to tell you that you did it and give you the check mark. And then you could download it, you could print it, you could close it. I'm going to close it. And I'm just going to close that out. And then once I do that, it's going to launch me. Uh-oh. I don't need DocuSign. We may have found an error. This is why we're not launched today. It's going to give you the CQG data stuff, guys. And the CQG data stuff is gone. That kills them. Is where you're going to get the information. Let me see if I can refresh this. That's DocuSign. I don't need DocuSign. So I'm going to finish. Sign it, finish. Hopefully this one goes through. And they may be working on this one. But this is where we're at so far. We're going to close it out. And fingers crossed that your trader contract, that's everything that you've just signed going through. I'm going to try hitting this close button. And we've got an error. So once you get the error, it's going to send you your CQG credentials after you sign. And that's going to give you your login for TradingView. So if you bring up TradingView, and Pete, I'm hoping you already have it, you'll go to your trading panel down here. Let me get out of paper trading. And you have different options, guys. Simulator, you can paper trade. CQG, when you sign up with Nexgen, they're going to send you the email. And what they're going to do is they're going to have you sign the agreement. And they're going to send you a username. And they're going to send, and you're going to create a password. And then when you're ready to go live, what you're going to do is you're going to go to AMP and you're going to click Live Connect. And it's going to ask you for your credentials. And I don't have mine in front of me right now, so I'm not going to worry about it. And then once you have your credentials in, you're ready to trade. You're ready to go. And then in your I'll do this one. Over here, you'll have your trading accounts, any active subscriptions. You'll have your user profile. You'll have your payment history, requesting payouts, evaluation accounts, access to the copier. All of this is there for you that you can use. And what's cool is on the copier page, you've even got, let me log out and go to my previous version. You've got your trading accounts. They show you your active trading accounts. If you have the copier, you're in open positions, shows your lead account, your follow account. It'll show you open positions if you have open positions. And that's really what it is. And then it's just getting in and getting to work, Pete. The sign up process really isn't that difficult. You just have to check your email. And when you check your email, it'll give you the login credentials for everything. And then you're good to go, guys. Then it's time to get in there and be consistent. Support resistance zones do not come with it. Premium, Steve, is TradingView. So premium is a level of TradingView. It takes TradingView Premium to be able to run market flow. You can get free supply and demand zones, or you can choose to pay for them. I have a paid version, which is $67 a month. I like them. The picture that I'm dropping in the room right now, dynamic supply and demand, Algo Alpha, is good. You cannot, Steve, you can run the two next to each other and execute in TradingView through AMP Futures, CQG, but the funding company is not set up to go through NinjaTrader right now. John is hopeful that with Kraken's acquisition, maybe they can work something out. But right now, it's a no. And then Pete, on your allocations, so what you're doing, let me log back in. I don't know why I closed that out. So your 1-to-1 is basically what you're saying. Come on now. Every one contract you trade in the leader account, it'll trade one contract in the second account. If you trade two contracts in the leader account, well then it's still 1-to-1. Two in the follow, two in the leader. If you want in your follow accounts, every one contract you trade in the leader account, you want it to trade 3 in the follow, that's when the ratios go up. So 1-to-1 means whatever you're doing in the leader account is going to happen in the follow account. Does that make sense? And let me see if I can get into my AMP one real quick. Let me pull up my username. And we'll see if we can't show you guys how that copier works a little bit. And I've taken about 17,000 pictures in the last day and a half. So let me see if I can find my user credentials somewhere. I'm looking, hold on, there we go. All right, so when you put in your user credentials, I'll pull this over. I'm gonna hit AMP from the trading panel, and I'm gonna go live and hit connect. And then there's a lot of numbers to go in, 9604. And this is just a pretend account, guys. It wouldn't do you any good to take a screenshot and copy it. It's not a real account. So I put in my credentials and I hit login. And now I've got my accounts up here. I've got my secondary account here. And if I go to here, I can see my leader account is 70, my follow is 16. So I'm gonna make sure that I'm in my leader account. And then what I'm gonna do is, let's see if there's, just for grins, guys, I'm not saying this is a trade. I'm gonna sell the market. And if I go back to here and hit refresh, it's not showing it to me. Oh, no wonder, because that's not on my account. Hold on. Go amp, okay. Now let's try this again. Since this says up, I'm just going to buy the market real quick. I won't put stops and targets in. But it shows me my lead account, it shows me my follow account, it shows me my P&L, the contracts, my fill price, my position. And if I continually refresh as that market moves, guys, you can keep tabs on things here too as well, which is pretty cool. So support resistance zones is an indicator for 67 a month or for free, Steve. If you choose to do the free version, the picture I gave you, the one that's awesome, that we couldn't find anything wrong with and were a great option for people, you could do that one as well. All you have to do is click on indicators and find that dynamic support zones, algo alpha, and if you click on it, it's going to add it. Is it spinning? All right, hold on just 1 second. Mine takes a minute, so it's spinning and trying to load right now. There we go, and now they've come up. Do they show up in your sidebar right here, Wayne? Guess I could look at your picture, huh? Squeeze it down. So gold has been consolidating for most of the day. That may have something to do with it. You found them? Okay, cool. Cool, cool, cool. Again, Steve, look up 6 postings. Let me get that out here again. Dagnabbit. There it is. Dynamic supply and demand, algo alpha. So I'll drop it in the room one more time for you there. And then, Josh, when I'm switching between charts from CL to ES, why does it keep disconnecting your AMP live? So if I go NASDAQ, I'm hooked into AMP. ES is on paper trading right now. So I do have to switch it. Whoops, I'm in a position apparently, and I'm losing it a lot. I don't know how that happened. So I have to log out of paper trading. And when I hit log into AMP, there's a concurrent connection warning. So it's already selected in another tab. And what happens is it'll put you on AMP on the ES. And then if you want to go back to the NASDAQ, you're going to have to go back. So it's not that it's disconnecting you, Josh. What it's doing is it's keeping you, you're trading one market with AMP. And let's do a test real quick. So can I go long in this market on AMP and go back to this one concurrent and have my funding company? There it is. There's my ES long. It's showing up on the NASDAQ tab. And then I could go short on the NASDAQ. And remember, I'm learning too. And I've got positions in both right now. So I could close that position. I can close that position. And I'm out of both positions. So what it does is it kind of bounces you. It makes sure that it's focused on whatever tab is open for AMP. That's a good question. I hadn't really thought about that one. And Wayne, you're good on yours. And I see John Novak just snuck into the room, which is always a good thing. All right, what else, guys? One of the things that I did too is I created, when you say pop out a chart, you're talking about, here's full screen mode. So you can go full screen mode. I'm not sure if that's what you mean. Or like John said, so if I click and drag on my NASDAQ chart, I can pull it out, and now I have a NASDAQ chart sitting alone on this one, like Google Tabs. So all I did was drag it. And if you look at my pop out, it's not in there anymore. And then if I take it and run it right back in, how do I get it back in? Click to quit the app, shift click or Alt F4 to close only that window, maximize, minimize. How do I get it back, John Novak? Close it and open it. All right. So I guess I have to close that one. That's okay. This is a good way to come through and see how to... Oh, that closed the whole app. And then when I bring the app back up, NASDAQ is missing. So if you're missing, go to the new tab, create a new layout. Watch this, and then just drop right down, go find your NASDAQ layout. And that's how long it takes to build a workspace. So Wayne, we got you. You can pop it out. I don't know how to pop it back in. And there's probably a lot on Google, like John said. But it's so fast. It takes 2 seconds to rebuild. Like I could wipe out everything and have new charts inside of 5 minutes. And it takes no time for them to come up. I love it. It's pretty easy. And then you can just slide it over like you would a tab. I like NASDAQ to be up front. That's typically, I just stink at it. Oh, you can drag it back. I'm just no good at it. Well, here, then I'll pop this one out. So I popped out gold, and then how do you put it back in? Have to use tab, not, okay, so the tab, boom, goes right back in. Thanks, John. So you have to grab the tab, not the whole thing. There you go, Wayne. Pop it out, pop it back in. Pretty cool. And guys, I'm still navigating a little bit. My focus lately has been, beer 30, not yet. My focus has been trying to build education to get you guys these trades, to make you comfortable with what we're doing on TradingView. Reminding you that we're using the same stuff that you're used to, guys. Triggers, defining trend. Areas, the same way we use them on NinjaTrader. A little bit in here on how to enter. Identifying momentum is absolutely no different. Zones and areas, aka termination conditions, guys, using zones for targets. So when you have those zones in, it's pretty cool. How do you get the scale of your charts to stop adjusting so small? Dun, dun, dun. Let me pull mine up real quick. So when you hit reset chart view, Josh, it goes tiny, right? Pain in the ass. I hate that. But I'll always do that. I'll reset and get that base point. and I'll give it one good swipe from the time bar down here to the left, and one good run up. And this isn't like Ninja. I don't even have to hit control. And now I'm right back where I want to be. So as they begin to run, I might need to adjust that one. The large chart, the 15-minute, rarely gets adjusted throughout the day. The small chart, sometimes you have to chase it if you get a huge move one direction. But I always, so like I might wake up and not see my indicators and be like, okay, I could chase it, or I could just right click and reset chart view. And then it's literally, it's one up, one left, and it's a very readable chart. You'll run out of wrist and it'll be the perfect size. Yeah, no worries. Supply and demand zones, guys. You're going to use them like you use fibs. If you're putting this next to Nexgen, you're going to use them with fibs and be twice as smart. Pivot stop outs are a thing, guys. One-to-ones printed in zones. Very powerful. That's a small chart termination. I'm going to get shit rich. I don't know. Is that a level of rich? John's on painkillers. Just two time frames working together. It's nothing new for next gen users at all. And then Steve, John, that's a you question. Not as good as the TV version. FO rich. Now I gotta figure out what FO means. Using two charts, guys. That's it. I like it. The same idea. Until price reaches a zone, guys, their targets. Once they reach a zone, it can become a termination condition. No reason to trade into it. 3 divergences is still a termination condition. And then getting into the trades, you have enough to tell anyone to F. Well, Wayne, that's the difference between you and I, is I'll tell them anyway. My filter has been broken for decades. Not nearly as broken as John Novak. So guys, high volume area trade. And Bob, this is what we were talking about on NinjaTrader. It's the exact same concept coming through. First, you have a zone reached, guys. And then the small triggers on the small chart have to tell you change is coming through rolling. And then buy or sell that pullback. So hit an area, whether it's a zone, whether it's one-to-ones, whether it's a divergence high. One-to-ones in a zone, even more powerful. Let the small chart, small triggers get to the other side of the large. Sell a pink line, that line in the sand, Bob. And guys, this is exactly what Nexgen has been teaching using the Renko charts for a long time. And then if you go back in the past even further, it's just an edge trade from 2004, back when we were using the candlesticks. It's nothing new. It's just wearing a different dress to try to entice you. The second trade is the trend trade. Gotta have a clear path. And then looking for that mid-band. It's a little different entrance because once you have all the momentum, once you have the clear path, you're going to let it pull back and you're looking for that mid-band. And we're not just buying at the mid-band because it's a 1-minute chart. There's some overrun. So the rules have you selling a close on the correct side. Zune v Fib, supply and demand versus Fib. They're similar but different, Boaz. Supply and demand is a little bigger range, but it's based on the same concepts, almost, not quite. And John's going to kill me if I blow this. Supply and demand, like Fibonacci, has a lot to do with what's already happened, where the market has already reacted, where buyers have already bought, where sellers have already sold. And what happens is when you have these supply and demand zones, very much like Fibonacci, they give you an indication of where the market may bounce. So in premise, it's very, very similar, although the math that goes into it is a little different. but it's the same in terms of trading away from them rather than into them. And you could draw your own if you wish, for sure. And knowing that they're there, knowing that it may be a place where you need to manage. So when you take this trend trade, the zone over here says, okay, this is a place that could create a bounce. This is a place that could give you a retracement. If you feel like taking profits, that's not a bad spot. You know where trouble is because of it, and it gives you a chance to just manage a little bit if you need to. And then finally, the momentum trade, and this is what all you guys are so into. Taking momentum with absolutely nothing in the way and just capitalizing. And the way it's being taught on TradingView is strong triggers on both charts, nothing in the way on both charts. And it's a little snapback. It's a little snapback to a fib, to a zone, to a one-to-one. And Bob, you'll recognize this as that down-up pattern. That same pattern that we talked about earlier in the room, guys. And these are the three that Nexgen is going to be talking about. It's absolutely nothing new. If you look up and read the conversation John just had with Steve, John has put the zones on NinjaTrader. Whoops. And he has deemed that supply and demand is more effective on TradingView. Fibonacci is amazing. John will show you a picture right now. And Bose, one of the things is you have to remember, Nexgen Software Services is a software company. Nexgen Funding is a funding company. And they have a different set of rules, a little bit of different constraints. And one of the things with Nexgen Funding is execution is going to go through AMP. And you're not going to be able to use NinjaTrader through AMP. And John does a lot of, and here's his side-by-sides, where John will use TradingView and have it running next to Ninja. And what he does is he's making decisions. He can execute on either. If he's in a Ninja account, he can do it over here. If he's in a TradingView, if he's trading the funding company, he'll just execute over here. He'll buy at the same spot. He'll sell at the same spot. He'll have zones that he's looking at. And it's a side-by-side version. I hope that made sense. So I'm going to give you guys right now, just so you can see it all. This is the plan that John and I have been working on extensively. And it'll probably just get better and better as we move forward. Let me enable editing and make that bigger for you guys. But I just dropped that one in there. And it talks about the basics, and then it goes through and it just gives the trade setups. It has all the workspaces, 1 minute with market flow, where entries are taken from, and then checklists for the trend trade, for the HVA trade, for the momentum trade. And then example trades and looks. He's got a couple of them here. It's a little cluster foxtrottery. So I've created the TV Trade Journal, and I'll drop it in the room right now too so you guys can see it. And what I'm doing is my days are spent taking pictures of HVAs, of trend trades, of momentum trades. And as I get things on management, I'm adding them in here, and I'm going to continually build this. And guys, you can take this one too and start building up yours. And there's also a tracking sheet as you go through TradingView with the same stuff, feedback from class, wins and losses, pictures for the trades. So it's the same concept. It's going to be repetition creates recognition. And then recognition is going to slow down the market, let you know exactly what you're looking for, and make it easier for you to execute in a new environment. Same rules, new environment. What else, guys? I've got nothing but time. And there's John's head-to-head, supply and demand, NinjaTrader, TV. And then John says, you can see, it just pretty much highlights tops and bottoms. John has all the toys. all the toys. Where the market may retrace to, will they break? Will they bounce? Do you have to hope and wish and pray into them? Or can you allow them to bounce, allow them to break? And that's kind of what we do is clear path, momentum, rock start out. Guys, you've got me. What else would you like to talk about? I know it's new, but it's not. This is your wife coming home in a new pretty dress, but it's still your wife. Momentum is down. I think so, right? It's nothing new, it just looks different. New hairdo. It's still the lady that said I do, or the man that said I do, depending on who you are. Probably not going long against momentum, right? And look what it does. It pulls back to resistance, and things start to roll. And there's your HVA line off the zone, everything down. Bob, there's your short. Let's see if they continue down. I'm excited, guys. I'm excited for everything that's coming together. I'm excited for TradingView, and I hate getting excited for new things. I really do. And it took me a couple weeks. 4 bars back, the green arrow, that's market flow, Andy. That's market flow. And the rules on market flow say, guess what? If your rules aren't met, this arrow doesn't mean anything. And Josh, of course I will. But let me back up and I'll just show you. Let's find one. Whoops, what did I do? That was weird. I don't know what I just did, but I'm pretty sure I did it wrong. So we'll go to the S&P. We're going to discontinue the trend trade. Lies. Here we go, Josh. Let's see what this looks like on the large chart. Never. I love trend trades. That's the only trade I take. We see where that comes up on the large chart. That's Wednesday, May 7th. Wednesday, May 7th. All right, so just work with me here, Josh. Everything on the large chart says down, right? We're coming from a pivot stop out, it's down. Josh, you're good at this. What a great look. Everything is screaming down. John, how do I get rid of the second set of small triggers? Can I just delete them? Why do we even have that? $21.83. $15 here. Oh, time value 15. Okay. See, guys, I'm learning too. Is that right? There we go. Perfect. Thank you, John. So, Josh, check it out. Odds favorable, clear path, right? Everything is screaming down. The momentum is easy to see. The fact that it hasn't reached an area is easy to see. Are you good with me there, Josh? Market pulls back, gets to the mid-band area, sell a close on the correct side of the small triggers. There's your trend trade. Geronimo. It's getting in on the right side of those small triggers. Because what happens a lot, and I'll find an example of it for you. Let's say, all right. So let's say everything says up, right? And you're coming down and it's coming into there. And yeah, you can do whatever you want. And what happens is you get to that area, but remember these are 1 minute bars, and you can see that triggers are strong, and you don't want to fight that strength. You don't want to fight that immediate strength. So you just a little bit of patience, let it close. Let it get to the other side, and you'll figure out timing a little bit. But if you try to go short right here, you're not at the mid band, right? And this bar says don't do it. And then that bar finally says go. And sure enough, it pushes down. And it's creeping and creeping and creeping and creeping and then closes. Me too. I want to follow rules and make money. And Josh, it's just like anything. You'll find your way to do it. You'll find your way to enter. You'll find your way to manage. You'll find your way. See if that turns into... But that's a good reason why, is you might be thinking trend trade, but you don't get your conditions met, right? So that close on the correct side of the triggers is a big part of it. It's a big part of that safeguard that the rules tend to give. Buy and sell at areas with triggers. When not with, wait for them to roll. There you go. So momentum trades, buy the area. Trend trades, let them roll. HVA trades, buy the area. Because the rules for momentum and HVA have the triggers in favor. It's the trend trade, Josh, that you're waiting for that little turn. And this is a good example too. See how it rides those small triggers up on the large chart, and then once it gets to the other side, down it goes? That's a great example. As you get in, you're good. It still goes down. And this is 15 minute, and then it turns into the trend trade. It's a similar concept. It keeps you from fighting the immediate momentum indicator. Good stuff. I like that this ran over. What other questions do you guys have? Throw them out there. And guys, because we're introducing TV doesn't mean that NinjaTrader's not a thing. That's every morning. We're going to go through NinjaTrader. We're going to go through these patterns. And the smarts that you guys have created for yourselves in NinjaTrader are going to help you as you go to TradingView. So large chart says down with odds favorable. Small chart's coming back to a zone. John says didn't take the trend trade here because the small chart said no. And then that 1 minute zone is holding and the triggers start rolling, I'm assuming. It's hard to see that one. He's on the right side of the small triggers. I can't get it to go bigger. And now he's saying, with momentum, the potential to break, coming off of the zone. I don't know how I feel about that one. Let me know how it works out. Kind of a continuation shot from a bad top. Yeah, I don't know how I feel about that one. I really don't know what I did here. So if you ever screw up a workspace, just close it. Get rid of that one. I'm going to close it without saving. I'm going to come over here and I'm just going to go back to my NASDAQ and just blammo. Damn it. It's still there. I have to fix that after class. And there we go, guys. Anything else this morning? Did we make it? Woo! All right, let me close.